President has joined.
Now ఇంకా 30 participants ఉన్నారు. 30 participants ఉన్నారు. ఇంకో 5 minutes అందరూ రావాలి. ಇಲ್ಲ ಸರ್ ಹೋಗಲ್ಲ.
Good morning to everyone. We should be starting the session in about 5 minutes. Thank you. I request everyone to rename their screen names as their business plan numbers so that we can take the attendance for that. Thank you.
So we have about 50 participants, and as we speak, more are joining. So we would allow another 5 minutes or maximum 10 minutes for everybody to log in and settle down. And then we can start today's deep dive knowledge session. Kindly bear with us, teams.
No. That's the issue. Are you going to see the screen or what's the plan? Sure.
Yes, we have.
Yeah. No, you said you would want to walk it down.
Yeah, we said that.
In control. Yeah. ಎಷ್ಟು ಜನ ಲಾಗಿನ್ ಆಗಿದ್ದಾರೆ? 60. ನಾವು ದಕ್ಷ ಎಲ್ಲರಿಗೂ ವಾಟ್ಸ್ಆಪ್ ಹೋಗಿತ್ತಾ ಇವತ್ತು? ಹೋಗಿದ್ಯಾ?
Dr. C.A.I.S. Prasad.
Good morning.
Good morning, sir.
Good morning, sir. We can hear you.
Yeah. Shall I start, Rahul?
Yes, sir. You can start.
Very good morning to all the team members and all the participants who have been selected for the second round. On behalf of FKCCI, it's my great pleasure and privilege to extend warm welcome to the today's resource person. Start with C.A. Shravan Gaduttur, who is going to dwell upon financial projections. And again, Suva Ganeshan, Madam, Chartered Accountant, Independent Director, EL Force Limited, freelance economic planning. She is going to dwell upon financial planning for enterprises. And again, Mr. Jagat Iyer, who is going to talk about factors that make a startup successful unicorn. I'm sure that all the participants yesterday had very benefited by the three speakers, B.R. Vishnath on business analysis, marketing and sales projection by Usha Nagaraj, and tips for preparing the business plan, how to pitch in 2 minutes. So I'm sure that today deliberations by all the eminent speakers and professionals will take you how to make you to draft the business plan and again move forward to get selected in 75 teams. I would like to place on record the entire team efforts under the chairman of Abhishek, B. Abhishek, and again today moderator Rahul Goyal, and would like to place on record the support of TAI and KEDAM and all the both UDAN, New Zealand of Engineering colleges, who has been come forward to provide 10 crore seed money and again Natal incubation has come forward to provide 2 crore seed money. Thanks to Subha Ganesh and again Ankur Basin and the entire Manthan team who has been taken for second round, the deep dive knowledge, which is going to help you. And my only, again, as I mentioned yesterday, all the participants to make use of this benefit. And if you have any small doubt, clarification, that have been available in the offline also, just get their wisdom, get their concept and inputs to make sure that your plans will be, or ideas will be selected by the jury for the next round. Thanks to all the jury members who have been evaluated the first round and continue to get the support and guidance of juries for success of Manthan. With this, I extend warm welcome to all the resource persons, CA Shravan Gadattur, CA Subha Ganesh, and Mr. Jagat Iyer. And of course, welcome to my young chairman Abhishek and the entire team, Rahul and others. Subha Ganesh also is here, I think, in the virtual. So thank you, and take the benefit of today's deliberation for your future. Thank you.
Thank you very much, sir. I now request our chairman, Dr. B.A. Abhishek, to present the Manthan remarks.
Good morning to all the students. How many do we have logged in now? 95. So I see a drop. Yesterday we had 188 teams participating. Hopefully they'll join soon. Thank you, President Dr. C.A.I.S. Prasad, for your opening remarks and the initiative of the 14th edition of Manthan 2022. Without your guidance, support, and initiative, this wouldn't have been as successful as we are today. I would like to thank the entire Manthan team, the workshops, the jury, the outreach team for all their support and coordination. Shravan, you're blocking. I would like to thank all the Manthan team, the jury, and everybody for their support. I'd like to thank all the sponsors for all their support. Thank you, all the sponsors. I'd like to thank KDM and TAI for their support. So this will be the second and the last day of the deep dive knowledge workshops. So I would request all the students to make notes and take inputs from the 3 speakers today. Shravan would be speaking on financial projections. Shubha ma'am will be speaking on financial planning, and Mr. Jagat Iyer, factors that make a startup successful unicorn. So based on all the deliberations and topics that were covered yesterday and today, we are giving you a chance to go back and revisit the business plans already submitted by each of the 212 teams. Make your modifications based on their learnings from the last 2 days. And we would request each of you to keep your updated business plans ready by the 30th of June. So mark that in your calendars. I would request all of you to please be ready with your business plans by the 30th of June. So that gives you about a week from today to update and keep your business plans ready. The round 2 of the jury would be from 1st of July to the 13th of July. So the tentative dates will be the 1st of July to the 13th of July, where each of the teams will be invited to present online. It will be a 10-minute presentation where the team members will be pitching, and followed by a 3-4 minute question answer session. So I would request all the teams to be ready with the business plans by the 30th of June. And by then, our team will get in touch with each of you and give you your specific schedule time slot where you would be presenting online your business plans with the jury. And based on the presentation, the jury will be evaluating and selecting the top 75 teams. Remember, teams, the top 75 out of the 212 teams will be qualifying for the next round, where everybody will be invited to Bangalore to be presenting in front of the jury here. So this presentation that you're doing online is going to be deciding who all will be selected for round 3. I'm wishing all the students the very best and happy workshop today. Thank you.
Abhishek, 1 minute. Abhishek,
Yes, President.
now you made what is the last date of submission for them for presenting the second round? And also, why can't you just give some of the resource persons offline where they want to have any clarifications or any assistance, which you can provide?
So basically, all the topics and that have been covered in the last 2 days will be uploaded and sent to each of you, the presentations. And if there are any questions that we are going to have a question answer session today after all the three speakers. So all the speakers will be available today at, I think the open question answer is from 1:15 to 1:45, where will be a half an hour specific question answer round where all the speakers will be available. I would request if all the teams participating have questions to keep them ready. And after each topic also we'll be having a Q&A session. In addition to that, if after the speakers presenting their workshops today, in the next week by the 30th of June, if anyone have any queries, questions, we are always available at manthan@fkcci.in. And if you can email your question and request which speaker you need the answer from, we will have that speaker connect with you and respond to your queries. So as President said, if any help that you would need even after today until the 30th, by when you need to submit your presentation, you can reach out to us at manthan@fkcci.in and we'll be more than happy to answer your queries.
When is the last date, Abhishek? When is the last date for submission?
We are requesting everybody to keep their presentations ready by the end of this month, the 30th of June, so that they can submit all of it. And starting the 1st of July till the 13th of July, we will be having time slots assigned to each of these teams.
Great. All the best.
Was it clear, President?
I want to bring to the knowledge of all the participants. It's a great opportunity for you to become unicorns, and we have been planning very big things for you apart from the seed money. We are going to support you to make you successful in your life. Thank you.
Thank you so much, President. If there are no more clarifications with the Manthan process, I would request Rahul to introduce the first speaker for today. Rahul.
Thank you, Abhishek, for the opening remarks. Our first speaker for the day is Shravan Gudutur, who is going to speak to us on financial projections. Shravan is practicing chartered accountant, registered valuer and director of FKCCI, and handholds startups in business and financial modeling, value discovery, valuation, certifications, and growth advisory. I welcome Shravan to make his presentation.
A very good morning to everyone present here today virtually, and few of my colleagues here present physically in the FKCCI Tally Hall. A very good morning once again. At the outset, let me thank the President, who has not left any stone unturned when it comes to raising the bar for Manthan as a whole, the 14th edition, which is actually possible because of his thoughtfulness, his vision, and overall his perseverance. I mean, he has been the man behind this. And I would like to thank Dr. C.A.I.S. Prasad for the whole Manthan initiative. And I would also at this juncture thank the chairman of the Manthan Committee 14th edition, Abhishek. Of course, only planning without execution doesn't make sense, right? So he's the man behind the execution. So having said that, let me also take this opportunity to congratulate all the 212 teams. I think you have passed your very first hurdle of being closer to your goal. So 212 teams, it's a fantastic achievement. A round of applause to all of you. And as the President and Abhishek mentioned, We are having these successive deep dive sessions so as to handhold you, so as to guide you in terms of bettering yourselves in preparing and presenting the business plan. So in yesterday's session, you have already seen that how to analyze the market, what should be the components of a business plan. You have also seen how to make a pitch in 2 minutes. Certain other important aspects have been covered yesterday. And all of you have also been beneficiaries of the first series of the knowledge workshop. So the very reason why we are calling this as a deep dive is we will be going kindly in sort of in depth on the various topics today. So friends, we all know that one of the very important building block of your business is your business plan. For any startup, he will have to really focus on coming out with a detailed business plan. And one such vital element or an important aspect of the business plan are your financial projections, right? So what are financial projections? Well, before we step into the what, how, and why of the financial projections, let me kind of set the tone for the next 45 minutes to 1 hour as to what we will be looking at. We will be, of course, looking at the basics with a couple of examples. And with a numerical or two, we will also be trying to understand what are the different kinds of projections that form financial projections. It could be the revenue projections, expense projections, and more importantly, the cash flow projections. We would be looking at all of these clubbed with a couple of important aspects such as break even and such other terminologies, which are very important when you dwell upon making this exercise of preparing the financial projections. Right. So keeping aside the theory for a minute, financial projections means that there would be an element of forecasting. So let's take an example. You, along with 2 or 3 of your friends, have decided to travel to a particular location. Let's say Goa, right? So that's what most of the college students generally plan. And more often than not, these plans don't turn out the way they have to turn out to be. But this time, let's assume you are actually going to Goa. So if you are going to Goa with your friends, what are all the things that you will keep in your mind? First and foremost, the mode of transportation. You would have to decide whether you'll be going on through road or air, or you'll be, and what are the dates you will be going to visit, and how many days you'll be staying there, and where you will be staying, and what are all the activities that you would like to do, what is the kind of food that you and your friends would like to have when you're there. So there are a bunch of things that you will have to plan well in advance when it comes to planning a trip. So another example could be, say, for example, you have your exam coming up in the next month. You will have to really plan for appearing for the exam, right from identifying what are all the subjects that you need to study, what are all the chapters you need to study, where is the venue, do you have your hall ticket, multiple aspects when it comes to writing an exam. Again, you will have to plan. So similarly, when it comes to a business, if you are a startup, you have to plan a lot of things. So today's session is all about forecasting what are all these important things. Again, when we talk about forecasts, it is forecast of certain future activities. Forecast is something which we can call it as the dead opposite of a blind guess, right? So in case of a blind guess, what happens? You really don't know. It's like tossing a coin. You don't know whether it's going to be a head or a tail, right? But forecast is a lot more scientific than just a guess, because you will be putting in certain efforts on the basis of certain tangible proofs, like your potential market size or your customer base or the resources available based on your business projections, right? So if we have to bucket these forecasts, we will be today looking at the forecasts of future revenues, future expenses, We will also be looking at forecasting of cash inflows and outflows. And finally, we will also be looking at forecasts of assets and liabilities. While primarily the focus is on forecast of revenue and expenses, and we will also dwell upon cash inflows and outflows, assets and liabilities is something which we will kind of, brush through. Say, is there a question? I request all of you to mute yourself, please. And in case anyone has question, please do unmute yourself and ask the question. Feel free to do that. So there are different kinds of forecasts, right? While it is bucketed into forecasts of revenue, forecasts of expenses, cash flows, etc., there are different kinds of forecasts. First is called as a short-term forecast. That is for your immediate future. That is generally up to the next 1 year. What your revenues could be, what your expenses could be. That is called as a short-term projection. Then we have a medium-term projection, generally 2 to 3 years kind of a time period. And then we have a long-term projection, generally 5 years and above. But having said that, we will be looking into the future, certain specific events, and that too scientifically, because it should not be just a guesswork. There is always an element of uncertainty, right? In the future, anything can happen. Future is always uncertain. Future is always dynamic. You'll never know. No person can, in 100% accurate manner, project anything, be it revenues or expenses or anything in your real life scenario, right? So similarly, in case of a business, with 100% accuracy, you will not be able to do so, right? Next is, let us see why we actually need to project. First and foremost, you project your revenues and expenses for your own self, for you to understand where you stand and where you project yourself in the future. Am I capable of making the sales that are necessary for me to survive in the market in the next 1 year, in the next 2 years? Do I have the necessary resources to perform these activities? Do I have the intellectual capital, depending upon the nature of the business that I'm doing? So multiple questions will come to your mind. So the way you project them in the form of numbers gives you these financial projections, which will help you in very vital decision-making activities. Next is the financial projections are required to give the necessary information to the investors. Why do investors invest in your business? They would like to see some kind of a return on investment, right? Any investor comes with a commercial mindset. He would want some kind of an exit or a return on investment. So if you are an investor and if you are investing in a company, the first and foremost that you would want to look at is the future viability of this business proposition. How will my sales pan out? Say if I am in a business of selling apparels, manufacturing apparels, and if I have multiple SKUs like say t-shirts and pants, if I have market for it and if I have a visibility into the future as to when I will be selling what, only then I will be able to convince an investor to invest in my business, right? How much profit would I be making? Is it a cash profit or is it just a book profit? Multiple aspects has to be looked into, and that's why financial projections are important from a investor angle. Next, you might be approaching a bunch of other outsiders other than investors for the purpose of raising funds. These investors are generally called as funding institutions. They could be your banks or other non-banking institutions or non-financial institutions like your friends and relatives, etc. All of them will extend some kind of a loan or a debt which is supposed to be repaid within certain amount of time with certain interest or sometimes even free of interest. So even for them to understand what exactly is the kind of possibility of the business to even repay the principal or pay the interest on a periodic manner is something that can be identified, judged from the financial projections. The next is, as you go along your path, let's say you are a manufacturer of some kind of a unique tablet that has come into the market. You have your own research and development team. You have come out with a particular medicine. You might expect that particular sales to happen for the next 2 to 3 years, and you have projected them. So after projecting these, you turn after a year, you find that the government has come out with some kind of a restriction on your formula. some kind of a restrictions which does not allow you to continue to make the sales anymore. So this is a kind of contingency that happens, right? So these financial projections help me on a continuous basis to identify what are these kinds of threats, what are these kinds of weaknesses that I face in my day-to-day life in the business, and accordingly will we be able to modify them? Are we able to adjust to the situation? And are we capable of modifying and proceeding further, either by way of coming out with new products or making modifications to the existing products, depending upon whatever the restriction is that is posed by the government, right? So this financial projections would help you in that as well. Anticipating problems, like I gave you an example of a problem that is created by external factors like the government in my previous example. You can have a lot of internal problems as well. Say, for example, you have a product for which you are supposed to import a particular machinery, let's say from China into India. So all these kinds of problems you should be capable of anticipating, or you will have a clearer picture in anticipating these kind of problems if you have a clear visibility of your revenues and expenses for the next 2 to 3 years, right? So the only purpose of having these financial projections is to kind of get a clarity into the future, and it is not just you, the management of the company, the owner of the company as a stakeholder who would like to benefit from this, but it is also these all external agencies like we discussed, the investors or those who are providing funds to the company who would be interested in looking at it. So the very purpose of financial projections is to convert some kind of a hazy or an unstructured goal that you have into a visible target so that you can break them into multiple pieces and accordingly plan for them. You can plan for sales out of this, you can plan for marketing out of this, you can plan for HR recruitment, that is, you can plan for multiple aspects on the basis of what is there in your financial projections. Let's understand, before we take an example and understand the numerical into how the projections actually take place, let me tell you the step-by-step process of how financial projections are actually created. First and foremost, you will have to identify what your spends would be, what your expenses could be, right? So your expenses, depending upon your business, whether you are into product manufacturing or providing services, you will have a lot of recurring expenses and fixed expenses. Recurring expenses are nothing but that recur month on month, one period to another period. Say, for example, salaries or rent for the business premises that you have taken on rent. It could be interest on the loan that you have borrowed, right? So these are all called as recurring expenses. It could also be your purchases that you purchase from your vendor on a regular basis. Those are also recurring expenses. Apart from recurring expenses, you will have a bunch of fixed expenses. So what are these fixed expenses? It is nothing but your first time investment into the machinery of the organization. It could be paying the upfront security deposit for a rental premises, or it could be purchasing of a license from a government authority, which would be generally one time in nature, right? So all these are in the nature of fixed expenses. So first of all, if I'm an entrepreneur, if I'm a startup, this is the very first starting point for me, right? So I need to be in a position to identify what are all the expenses I have. Subsequently, I should also be in a position to project the sales I have. I think in yesterday's session, one of the earlier speakers spoke about how to identify the target market. Out of the target market, how much of a market you can acquire, the SAM, SOM, and all those things must have been discussed, right? So once you know what your potential market is, on the basis of that and on the basis of the capacity that is available in terms of resources, both intellectual and capital resources that you have, what is the amount of sales that I can make in the next 1 month, in the next 6 months, in the next 1 year, etc. So that's the very first step. The first step is all about your sales projection and your expenses projection. In a very simple manner, it could be, the visibility could be only into the next 1 year, not necessarily the next 2, 3 years or 5 years. So you can look into that on a case-to-case basis, depending upon the nature of your business. The next is understanding the cash flows. At this moment, let me tell you that many of us think that profit is the king in a business, right? While in reality, it is not just the profit, but it is also the cash. Because you might be a very profitable company, but you might be really running helter skelter to meet the ends in terms of cash flows. You might be generating profit, but you might not have enough money to pay for the recurring expenses. Why does this happen? Because of the very fact that business runs on something called as a credit period. I receive some credit period from the vendor from whom I purchase goods. I have to offer some credit period to the customers to whom I sell my goods. So because of this, there is always a cash flow issue. So while in the first step, we purely looked at sales and expenses. In the second step, we have to match them to the related cash inflows and cash outflows. So how do we do that? Again, we will get back to a numerical example. Right. So the third step that you'll have to do is determining the various financial needs. So once that you have understood, this is my fixed expense, this is my recurring expense, this is, I have to pay, let's say 1 lakh towards salary in the first month, second month also I'll have to pay the same amount, I'll have to pay a certain amount towards rent in the first 2 months. On that basis, I should be in a position to identify what is my total capital outlay. In other words, what is the total financial need that I have, right? So we have to keep that in mind at the time of preparing the financial projections. The next is building multiple scenarios. So what are these scenarios? Again, like I mentioned, we are looking into the future where you really don't know if the things pan out the way you have planned them to pan out, right? So there could be many uncertainties. There could be various problems that you will have to face. So what we suggest all of you is to identify a best case scenario, an optimistic, pessimistic, and most likely scenario. So 3 different scenarios when it comes to sales. Say, for example, if I'm in the business of some kind of a edutech business, a SaaS platform where I have certain subscribers on my platform, I might expect that online training might be in the boom in the next couple of years. There will not be any issue. At the maximum, at the highest extent, I will be able to acquire 100 subscribers per month. This is the best case scenario or the most likely scenario. Then you can also be more optimistic about it. You can also say, I can still reach out to a bigger market, a bigger geographical area. Instead of just saying that this is the most likely scenario, I can go up to 150 subscribers per month instead of just 100 subscribers per month. That's called as a optimistic scenario. And worst case scenario is called as a pessimistic scenario. Let's assume I will at the bottom line, at the worst case scenario, I will be selling only 20. I'll be getting only 20 subscribers. So we have the most likely situation, that is 100 subscribers. We have 150, which is the optimistic scenario, and then we have only 20 subscribers as a pessimistic scenario. So you need to have all these scenarios just to understand where you stand, right? So for each of the SKU that you have, for each of the business vertical that you have, you could be running a business which is both into product as well as a service. For each of the vertical, you need to have these kind of scenario based modeling so that you will at least know where you stand in case of a windfall or in case everything tumbles down, right? So you'll never know. So next is planning for contingencies. Again, like I said, business in the future is uncertain. There could be a situation where the government put some kind of a penalty on the business that you're doing because you did something wrong or you didn't comply something in the right way, or you might end up having some kind of a quality issue with one of your customer, right? Let's assume you are in the business of manufacturing some kind of a health drink. So if this health drink is having some issue, though you are FKCCI approved or all other approvals you've got, let's assume tomorrow there is some kind of a contamination of this health drink because of which the customer has put a case against you. So that is also something which requires some kind of a cash outflow. That is a contingency, because these kind of contingencies can happen. Multiple situations can happen and you need to be in a position to foreseeing them. There could be legal expenses. There could be other expenses that you have, right? So what you can do is all these kinds of contingencies based on your business, has to be based on your business, has to be projected. And the final step for you would be to monitor and make necessary changes as required. So why should I monitor my financial projection? I have to monitor because of the very fact that there will be a lot of changes as we take the path of the business, right? So 6 months down the line, I find that there is a potential for another product that I can start. So my financial projections should be flexible and dynamic enough to add that another product. Okay, after 1 year down the line, I will identify that there is a huge one-time expenditure that I have to make because the machinery that I am using is of no more use. I'll have to import or I'll have to purchase indigenously another better quality machinery. Again, you might not have foreseen this on the very day one, right? So all these kinds of changes should be brought into your financial projections, and your projection should be made dynamic to that extent. So now that we have understood the 6 steps towards the process of preparing the financial statements, let's make it more practical by taking a case study. So the case study is on your screens. So what is the case study? There is a company called as Smoggles. Smoggles is actually a manufacturer of smart goggles. Apparently, this particular company has come out with a kind of unique goggles which has a capability of all the features that a smartphone can offer with an integrated camera in the goggles. So that is what is called as a Smoggle. That's the name of the company. This particular company has only this particular product for the time being and the related services and accessory sales, right? So this company is having its assembly unit or the manufacturing unit in Bangalore, and the customers could be anywhere across the world, not just in India. And Smoggles has started its operation just 1 month back. So they are kind of really struggling to kind of prepare a financial projections. And as you already know by now, why financial projections are required, right? So we discussed that you as a management person will have to look into it. You as a investor will have to look into it. So there are multiple reasons why you need to have the financial projection. So for the same reason, even Smoggles wants to identify and build a strategy around it. Let us look into their revenue projections to start with. I will be putting these numbers in a very simple format, and then we will take slightly deeper examples. Okay, so this is a very simple projection for 1 year of Smoggles, that is the smart goggles. So in the first year, as you can see, they have estimated a sale of 1,000 units of goggles. I repeat, they have estimated a sale of 1,000 units, as you can see over here, and each unit selling price is 5,000. So 1,000 rupees, 1,000 units multiplied by 5,000 rupees each unit gives me 50 lakhs of revenue. I repeat, this is the sale value. Still, we have not gone into the cash inflow and outflow. Please remember, right now we are discussing about only the sales. So in the first year, they are capable of selling 1,000 units of their goggles, and they are capable of selling 250 units of their accessories. So each unit of their accessory is having a selling price of 500 each. So 250 into 500 gives me 1,25,000. So overall, in the first year, I have an operating revenue of 51 lakhs. So what is operating revenue? In this example, it was a case that they have only goggles and the related accessories as the revenue stream. It could be the situation that in your business, there could be certain service verticals. There could be a mix of sale as well as a service element. Multiple verticals are possible, right? So all these directly attributable revenue generating sources of the company are called as operating revenues, right? So in this case, the total operating revenue, they have about 51 lakhs they projected for the next 1 year. That is for the year 2023. Are we clear till now? If there is any questions, like I mentioned, feel free to unmute yourself and ask me questions then and there. All right. So let's look at, now that we have seen the projections for the year 2023, let us see how they would project for the year 2024. So in the year 2024, their estimation of the sale of goods has gone up from 1,000 goggles in the first year to 1,500 goggles in the second year. Can you see that? 1,500 goggles in the second year, while they have kept the selling price of each unit as the same. They have not modified. 5,000 was the selling price per unit in the first year, and so it is in the second year as well. So 1,500 units into 5,000 gives me a revenue of 75 lakhs. So that is my projection, right? So again, I will not get into how I arrived at this, because on the basis of the market survey, on the basis of identifying your potential market, on the basis of identifying which is your immediate addressable market, you have arrived at these numbers. There's so much potential is there for your market to sell, on the basis of also understanding the competitors, right? And your pricing is accordingly derived at. I'm not going to get into that because we are looking purely on a financial projection aspect today. Again, even your accessories from 250 units has gone up to 300 units of sales in the second year. Again, the price remains the same. So they have projected a total sales of 76.5 lakhs in the second year. I hope now you understood that how the first year has panned out into the second year in terms of the revenue projections for this goggle making company, right? Let's look into the third year projections. Now, at this moment, before I dwell into how the third year projections are done, you might be having a question, how many number of years do I have to really project, right? So there is no hard and fast rule as to how many years of projections is the right number of years of projections, because the longer you go, the lesser certain you will be in terms of realizing those numbers, because you will be looking so much deeper into the future, so much farther into the future, that you will not be in a position to make a justifiable estimate. So generally, these kind of projections are limited to 3 to 5 years, or for your business plan that you are preparing, even 3 years is absolutely acceptable, right? So that's why I have given you an example where 3 years of projections have been considered. So now that we have seen 2 years of projections already, I have just replicated them. The third year projection, they have increased from 1,500 units of goggles to 2,200 units of goggles. And they've also increased the selling price from 5,000 per unit to 6,000 per unit. As you can see, I've highlighted them in red color. So that's the change that they have made in their third year of projections. And the related accessories also has been increased. When it comes to the sale price, they have moved from 500 per unit to 650 per unit. And they've also projected a slightly higher number of sales estimate for that particular year. So as you can see, the overall revenue projections has moved 49% from first year to second year, and 76% from second year to third year. So this is in a very simple manner how you can do projections. Since I've also seen a couple of business plans that all of you have submitted, I am a part of them were actually able to understand what is expected out of a financial projection, and they were able to convey it properly. A few of them were still not able to convey properly. So you will have to really understand that projections is not an easy task. A lot of it depends upon your specific industry, your specific market, the kind of competitor structure that is there, etc., that I mentioned to you before. So are we clear on the revenue projections for 3 years? Are there any doubts? Okay.
Good morning.
Morning.
This is Dr. Dhanasu, the mentor for a candidate. So in the projection, what you have to, there are so many factors based on that the projection will be done.
Right.
So whether we have to make the projection on an actual basis, or we can go a little bit lower the actual basis.
Right.
Market scenario.
Right. So like I mentioned before, there are 3 different scenarios that are possible. You might have an optimistic estimate of sales. You might have a likely estimate of sales, and you might have something called as a pessimistic, or the least number of sales of units that you can do. There are 3 different scenarios that are possible. Again, depending upon business to business, again, product or service, how the competition is, what is the kind of market that you're entering into to start with. Say, for example, if you're in Bangalore, you might want to focus on Bangalore customers first. And for me to do that, do I have the necessary resources? If I have the necessary resources, then yes, why not? I can be more optimistic about it. If I have the market size, if I have demand for the product or the service that I have, and if my pricing is good enough, then I can be optimistic about it. But if any of these factors are turning out to be
Your voice, I'm not able to hear. Some problem is there, I think.
sir, you cannot predict the future, sir. Like I mentioned, this is not a wild guess, but this is more of a scientific guess, because you are to a certain extent making some research, certain extent having some statistics, how your industry is performing, etc. On that basis only, you're making this estimate or a future projection, but it is definitely better than a blind guess. So I wouldn't say it is completely 100% sure that you can achieve it, but there is an element of uncertainty even there. Was I able to answer, sir? Dhanasu, sir?
Yeah, I got it. I got it. Thank you.
Sure, sir. Can you all see the screens?
Yeah, we are able to see the screen.
Sure. Now that we have understood the different ways of projecting revenue and how you will have to project the revenue for, say, 2 to 3 years, let us look at how to project the expenses for your business. In this case scenario, again, we are continuing the same case study of goggles manufacturer. As you can see on your screens, the very first line is the revenue that we just projected year on year. That is 2023, 24, and 25. Until the previous slide, we saw how these numbers are arrived at. The idea of discussing this particular presenting this particular slide is to take a deep dive into what are all the expenses that this particular company can have. Like I said, if you can recollect, this is a goggles manufacturing company. It will have some directly attributable expenses because it's a product-based business that they have. So first and foremost, they will have to purchase some relevant components. It could be the frame of the goggles. It could be the plastic or the metal that is used there. It could be the glasses. It could be the technology. It could be a chip that you have inserted, the camera lens, etc. Right? So all these are the different components that the company will have to purchase. So the cost of purchase of all these items, to the extent they have helped, to the extent they have been consumed in making the sale, will have to be considered under cost of goods sold. Again, you can ask me this. In this example, we have put some numbers, right? So in your case, you'll have to really identify if you are in the business of making some kind of, let's assume you are manufacturing some kind of an agricultural equipment. For you to make that equipment, what all do you need? You will have to really boil down to each individual aspect of your product and identify the cost that is involved in relation to it, get quotations from the vendors, and on that basis you will have to make this estimate for the next 2 to 3 years, right? That is how the cost of goods sold is arrived at. Next is marketing or advertising expenses. For any startup, this is one of the heavy expenses that they'll have to meet, which we also called as the customer acquisition cost, which again depends upon business to business, service to service, and product to product. There is no standard formula as to what it is. If you are a tech-enabled online business platform, definitely the customer acquisition cost would be roughly between 40 to 50% of your sale itself, most of the times. Again, it depends upon the channels of advertising that you're choosing. If you're going for an online advertising, if you're going for, say, Google, or if you want to go for, say, some kind of a consultant who can help you in marketing or advertising, or you're using any of these social media platforms, they have their own costs, right? So all these put together is called as the marketing costs or advertising costs. So again, on the basis of your business, you will have to identify what are those expenses and how those expenses would be either increasing or decreasing year on year for the next 3 years. Next is definitely the salaries. Salaries include salaries of your own team, that is on the manufacturing floor, to whom you give the wages, to the admin team or the tech team to whom you give the salaries. All these put together, you will have to estimate year on year, along with their increments year on year, along with increase in hirings. Obviously, when you want to move from 1,000 units of sales in first year to 1,500 units of sales in the second year, to that extent, you need to be supported by the team as well. So obviously, there will be an increase in the salary cost also year on year. Next is equipment hire. Equipment hire is something again specific to this particular company. Since this company is into the process of manufacturing or assembling goggles, they might have to buy some units for the purpose of fixing or welding or, manufacturing certain products in-house, or attaching, say for example, putting the glasses to the frame or putting the lens inside the camera and fixing the whole structure to the goggles itself. For all these purposes, you need equipments, and for all you know, you might not be having the necessary financial assistance to buy these kinds of equipment. So I might choose hiring these equipments as an option. So when I go for hiring, then I will have to pay certain rent for the equipment, or I have to pay certain rent for my premises in which I'm carrying on these operations. So all of them will come under rent and hire of equipment. And then we have few other expenses like consulting, subscription expenses, utilities, electricity. All these are kind of self-explanatory, right? Interest on borrowings. If I have certain loans, I will have to give whatever is the rate of interest, 12%, 15%, whatever that is. That also has to be factored for. That is also an expense for you. Transportation, repairs, maintenance, and certain other miscellaneous expenses. Like I said, you need to also factor some kind of contingencies. So those contingencies can be included under your miscellaneous expenses, right? So are we clear on the different expenses possible? Again, these expenses have been put together on the screen on the basis of the case study that we have. Right. So on the basis of this, we have arrived at the total expenses for the years, that is year 1, year 2, and year 3. And as you can see, finally, we have arrived at the net profit or loss. So for the first year, there is a net loss. Why? I have sold only 51 lakhs worth of products. But for me to make those products and sell them, I have incurred expenses worth 58 lakhs. So finally, I have a loss of 7+ lakhs. In the second year, what has happened is, at the end of second year, I have attained something called as a break-even. So what is break-even? Break-even is a situation where my sales are equal to the expenses of making those sales. All expenses, fixed costs, related depreciation would be there. It could be recurring expenses. It could be one-off expenses. All kinds of expenses, as you can see over here on your screens, all of them put together equals to the sales. So since the sales is also 76 lakhs and expenses are also 76 lakhs, it is a situation of break even that they have achieved at the end of the second year. And subsequently, it is in third year that is where they see the profits for the very first time, right? Are we all clear on this slide? Are there any questions on how expense projections needs to be made? Anyone?
Yeah, again, Dhanasu.
No problem. Tell me, sir.
It is the salary in the third year, it is 25 lakh it shows.
Okay.
But in every year, the advertising marketing expenses is slightly more than the salary. Whether it will be costing that much, whether you have to project like that?
Again, this is an example in relation to the case study that I have taken. It could be a scenario that your business will have a lot of salary cost or employee cost compared to the cost of the items that you purchase, or compared to the advertisement expenses that you have. It is dependent, sir. There is no standard formula that the salary should be higher than any other expense or anything like that. In this case, it is a situation that the number of employees that they have is slightly on a lower side. Again, depends from business to business. There is no standard formula for that.
My point is that whether this is advertising marketing expenses will be higher than the salary. The salary, yeah, definitely, as the unit of production is getting increased,
Right.
the number of employees also will be more, or year on year, then there will be some increment on the salaries, other thing that will go. But
Right.
the advertisement and marketing expenses, whether it will be more than the salary what we are giving.
It can be. Let me explain you a situation. Since this company is into manufacturing and selling goggles, what happens is whatever is the technology behind making this, whatever is the design related cost, everything would have generally happened in the first year itself. From subsequent year onwards, I will not be again and again spending anything on hiring new people to again develop the technology, hiring new people again to, that's where my major cost is. So to a large extent, my cost in relation to the setup where the resources are required, technical people are required, would have been captured in the first year itself. Subsequent year, the increase in the staff would generally be in relation to the admin or in relation to staff on the production floor, since we are talking about a manufacturing entity and not necessarily from the technical team or the research and development team. And when it comes to advertising, it again depends upon how optimistic you are about your projection plan. If you want to really push through the market, you might want to spend a lot more on the customer acquisition cost. To that extent, it will be higher.
So I had a question actually.
Yes.
Yeah, hi, this is Kanchan here.
Mm-hmm.
Hello, can you hear me?
Yeah, I can hear you.
Yeah. So hi, so I'm Kanchan, and my question was around interest on borrowings. Where have they shown that they've taken a loan? And the second question was around subscription expenses.
Mm-hmm.
Yeah, second question was around subscription expenses. I just want to understand what are the subscription expenses, because consulting expenses I can understand. But what are the subscription expenses?
Sure. Okay. First question is you have on the interest on borrowings. Again, we have till now seen only the revenue projections and expense projections, while the loans or the borrowings are a subject matter of a separate statement called as a balance sheet, right? All your assets, all the sources of capital are a subject matter of another statement called as balance sheet. So the loans will be there in the balance sheet. So only the interest part of that particular loan will be captured as an expense in your expense projection sheet.
Okay.
That's your that's the answer to the first question. And the second question that you have is on the subscription expenses. See, subscription expenses could be anything. It could be subscribing to your any databases. For it could be, say, some kind of market research, you have certain databases, or it could be certain cloud platforms where your entire data is saved, like your Google platforms, etc. So there could be multiple other things where you'll have to pay some recurring subscription charges. Cloud database server charges, again, they are generally subscription charges. So all those come into the meaning of subscription charges.
Okay.
Since technology is used in this particular product, there would be certain tech-driven information that has to be stored, transmitted, etc. For that, you need to subscribe to certain databases, right, or servers. That cost is included here.
Sure. Thank you.
Yeah. Hello, Shravan. This is Shreyas.
Hi, Shreyas.
Yes. My question is the idea which is still in ideation stage. How can we put the financial or expense projection there? So I wanted to get clear on.
Right. Shreyas, right?
Yes, Shravan.
Yeah. Shreyas, for any particular business, for you to check whether it is a viable business or not, you need to take a pen and paper and put some numbers, right? You need to put some numbers in relation to what is the potential sales that I can make. Like I said, it need not be a 1 year or 2 years. Let's assume a short-term projection of in the next 1 month, what is the potential of those sales? It could be 1 unit or 10 units or 100 units. And the related expenses. I agree that you are still in an ideation stage. The fact that you have come to that stage, you will find, while we can agree that there would not be a concrete view in terms of how much could be your market and things like that, how much of a market you can serve and things like that, there will definitely be an element of what part of the market you can capture, because without understanding that, working on an idea is a waste of time, isn't it? Ultimately, you want to make money out of the business. The wealth creation in the hands of the stakeholders is the very reason why you have even taken up this venture. Stakeholders can be you yourself or anyone who has come as an investor, right? So for you to identify whether the product can actually take off, whether the product or the service can actually give some profits in the future, for me to address all these questions, I need to put certain numbers on a paper and identify, right? So that's nothing but the financial projections that we have. Maybe in your case, you might not have the visibility into the third year or second year, so to say, but at least the foreseeable future, a short-term projection is definitely possible. Am I clear?
Thank you.
I have a question.
Go ahead.
In the first year, I have incurred loss of 7 lakhs.
Okay.
Should I carry forward the losses to next year or not?
Yes. Okay. So since we are talking about the expense projections over here and not necessarily the taxation angle, your question is more from a taxation angle, like how much taxes I need to pay, right? So what happens in the first year, you have a loss of 7,12,000, right? So this 7,12,000 in the first year, you don't pay any taxes. As you can see, it is zero in the first year. And second year, since you did not make any profit, you're not paying any taxes over here also. But in the third year is when you're actually making some profits. So when you're making these profits, these losses can be set off against these profits, and only then you can, on the remaining balance, you are expected to pay the taxes. There are a couple of conditions. Again, I don't want to get into those income tax specific areas, but to answer your question, the simple answer is yes, you can set off the 7 lakhs against the profits as and when they occur.
Thank you.
Yeah. Moving forward, cash flow projections. Again, for the purpose of simplicity, all cash flows can be bucketed into 3 different types. The first and foremost is called as operating cash flows. Let's assume let's take the example of the same company, Smoggles. The money that it collects from the customers from selling the goggles is operating cash inflow. The money that you pay to the vendors for the purpose of buying the various raw materials or components or items that are going to be used in the goggle making business is also operating in nature. The money that I pay to my employees is operating in nature. The money that I pay to my landlord as rent is also operating in nature. So much so that whatever we saw in the previous slide, most of them are operating in nature, barring a couple of them. I repeat, most of them are operating in nature, barring a couple of them. So what are the others? The second kind of cash flows that you can have is called as the financing cash flows. So what are financing cash flows? Any cash flows in relation to any financing activity. I took a loan, I repaid the loan. I paid interest on the loan that I have taken. All these kinds of transactions, as you can see on the previous slide, the interest on borrowings is something in relation to the financing cash flows of the organization. Only the interest on borrowings on this particular slide. And finally, you have something called as a investing cash flows. So what are investing cash flows? Any cash flows in relation to, say, fixed assets. I have purchased an asset, I have sold an asset, I have charged certain depreciation or amortization on a particular asset or an intangible asset. All these are in relation to investing activities. Or say I have invested certain money in, I had some surplus cash, I have invested that money in a fixed deposit or a mutual fund. I get interest from that fixed deposit. I get certain returns or dividends from the mutual funds. All these are in the nature of investing cash flows, right? So this is the broad level of what are the different kinds of cash flows. Let me open an Excel sheet and just a minute. There is a very simple example of how a cash flow works. With that, we will conclude this session. Can you all see this elaborate Excel sheet on your screens right now?
Yes, we can see that.
Right. I hope you can see the numbers. Okay. So what is a cash flow statement? Till now, we have spoken about sales and expenses and not really the cash collections and the cash payments for the expenses, so to say, right? So, like I said, a business will have to have some kind of visibility on the cash flow position. So, when I say that, how much of money do I have today, or how much of money will I need tomorrow to reach whatever is the target, whatever is the goal that I have? So, if I start today, let's say with 1 lakh rupees of my own funds, as you can see over here, cash balance at the beginning of the period. So when I say cash, it is a combination of cash and your bank balance, right? So you start with your own capital of 1 lakh rupees as on 1st of January 23, because the business start date is 1st of January 23. I have projected what are all the cash inflows and outflows on a month-on-month basis for 1 year for the purpose of simplicity. Okay, so I have to this 1 lakh in the first month, I will have certain inflows and certain outflows, isn't it? What can you mute yourself, please? Right. So in the very first month of operations, say January 23, you will have certain cash inflows from the sales of goggles. Let's assume you sell only 2 goggles in the first month. So 5,000 rupees is a sale value per goggle, right? So you collect 10,000 from the customers. So that's the cash inflow that you have in the first year. Similarly, you have taken certain loans from someone of 50,000 rupees. That is also a cash inflow, right? We are not differentiating between what is an expense, what is an income, what is an asset, or what is a liability when it comes to the cash flow statement. We are purely looking at all transactions from an inflow and an outflow perspective. So right now we are discussing on the various inflows that are possible. So the first one was a cash sale related inflow of 10,000. Second is an inflow in the form of taking a loan of 50,000. And then there are certain investments that are received to the extent of 10 lakhs. I repeat, there is a total of 10 lakh 60,000 worth of cash inflows in the first month of operations. Now, can you scroll down a bit? Can you see, are there any questions on the sources of cash or inflows of cash? Any questions? Okay. So now can we take examples of application of cash, or in other words, cash outflows? So for the purpose of manufacturing goggles, just because I have sold only 2 goggles in the first month doesn't mean only raw materials in relation to only those 2 goggles I would have purchased. It is highly impossible, right? You need to have some amount of inventory also. So you need to buy, or you need to spend a lot more on purchasing all the raw materials, even though you make only 2 sales or 0 sales in a particular month. So what are all the amounts that you have spent in purchasing these raw materials? That is called as purchase of materials or components. I have purchased worth 1 lakh. In the first month, I have spent 1,20,000 rupees worth of advertising. You can ask me, I have made only 10,000 worth of sales, but I have spent 1,20,000 towards advertising. Is that feasible? Again, the answer is the advertising spends that you have made is something that can reap benefits over a long period of time. It doesn't mean that 1,20,000 you have spent, the value or the worth of it or the effect of it will die at the end of the first month itself. It's a continuous affair, right? Because what I have spent in the first month towards advertising can give me sales in the second month or third month or even 1 year from now. You'll never know. So this is the amount that I have spent, actually paid 1,20,000 towards advertising. Then I have paid 1 lakh towards salaries, renting of equipment about 2 lakhs. Similarly, I have a bunch of other expenses totaling to roughly about, can you scroll down a bit? Yeah, totaling to 10 lakh 33,000. So at the end of first month, what do we have? We have we have total spends of 1,33,000, whereas total inflows were 10,60,000. Total expenditure is 10,33,000, and I have a closing cash balance of 1,26,000. So how did I arrive at it? I had an opening balance of 1 lakh, which was the initial capital that I had bought in along with me when I started the business in January 23, to which I added roughly 10 lakhs of various cash inflows. A majority of it was an investment. Very small amount was the sales. And then I have 10,33,000 worth of different expenses in that particular month, for which I have actually paid the cash. Again, we are talking about cash inflows and outflows. So to the extent of 10,33,000, I have actually paid the money. And then at the end of the month, I have a balance of 1,26,000. So how did I arrive at it? 1 lakh plus 10,50,000 minus 10,33,000 gives me 1,26,000. So this 1,26,000, which is the balance at the end of the first month, becomes the balance at the beginning of the second month. Can you all see this? That 1,26,000 becomes the cash balance at the beginning of the month of February 23. So similarly, you will have to see how your cash flow projections will be made month on month. See, when we talk about one whole year, you might not be able to put a number to it so easily. But the moment you look at these on a monthly basis, or for that matter, even if you want to do this on a weekly basis or a fortnightly basis, welcome. But generally, it is done on a monthly basis. You get a lot more visibility into what kind of cash outflows you have, what kind of cash inflows you have. Let me take a small modification in this. Let's assume in the second month, you were supposed to get this investment of 5 lakhs. I will delete this. You did not get any investment. So what happens? You have expenses of 6,49,000. You have cash inflows of only 25,000. You have gone a cash negative of 4,97,000. Can you see that? In the second month, you are supposed to pay for money for various expenses, or it could be interest on the loan that you have borrowed, or raw materials, or salaries, etc. But you do not have enough money. So if you don't break it down at this granular level, you will not know how much financing you would need, right? So that is why this particular sheet becomes very, very important. Over and above your P&L statement, over and above your revenues and expenses, a business will have to first and foremost focus on its cash flow statement. This is a statement which gives me a position that I would be 2 months from now. So what should I do today? In February 23, I know that I will be cash negative. I am in January right now. What are the steps that I need to take? I need to look for funds. I need to look for some investment, or else I cannot meet this targeted expenditure. I will not be able to meet my target. I will not be able to reach my goal. So that's how you do the planning. Are we all clear? Any questions? This is my last slide. If we have any questions, this would be the right time. Anyone?
Yeah, it is clear.
Yeah. Sure. Then if there are no questions, this is where I conclude. Thanks to the overall the entire team of FKCCI and Manthan, the 14th edition. Thanks for this opportunity. Over to Rahul.
Thank you, Shravan, for your valuable inputs on the financial projections. I would now like to introduce our second speaker of the day, Ms. Shubha Ganesh. Ms. Shubha Ganesh is a director, founder, freelance writer, consultant, guest faculty of IIMB. She is an independent director at L Forge Limited, which is engaged in business of manufacturing rough steel forgings, and is also founder of Money Siksha, which is a financial literacy venture for empowering retail investors to manage their investments. I welcome Ms. Shubha Ganesh to make her presentation for the day. Thank you.
Good morning, students.
Good morning, ma'am.
First of all, I would like to congratulate all of you for clearing the first level of business plan with FKCCI. And now you're all ready for the second level, where you will probably put your business plan ideas into a better shape with projections, and will be able to clear that round too. So best wishes for that before we begin the session. So we have been having these deep dive workshops from yesterday. You have gone through the technical feasibility by Mr. Vishwanath, followed by marketing feasibility by Mrs. Usha. And later on, you understood how to pitch for your 2-minute pitching by Mr. Chinmay. And I would really like to thank Shravan today for explaining the financial projections in such depth and yet simplify it for all of you. So now I'm going to take a different tack about finances and try to explain finance in a simple way, because everybody feels finance is difficult to understand and difficult to follow, right? So let's look at it. Okay, so let's look at some statistics. What does this slide say? So by the way, all of you can answer all my questions by unmuting yourselves, and I would like to have a participative section with all of you. So what does this slide say? We are looking at some statistics. It says how small businesses start having problems and run into trouble because of few things they don't anticipate and they don't plan. So 82% of the startups struggle because of poor cash flow management. 79% say too little money and they have not planned for it properly. And some people don't price their products correctly and either are selling their products for a lesser amount and hence are not able to make profits. And some are very over optimistic about achieving sales. So how do you overcome these kind of issues? By projecting your business plan properly and planning in such a way that you are more successful than most people in your business. So how to be successful in business requires a very important skill, which is handling money. Unless you know this skill, it is very difficult to be a successful entrepreneur. Money is like oxygen, like how we need oxygen to breathe. Similarly, money is what makes a business go around. Any business needs money to live. Okay, so understanding this skill in a very rudimentary way is what most entrepreneurs need. Yes, you could say that I have a chartered accountant who can help me make the finance projections, but understanding how the numbers are put, Shravan was explaining to you how the projections are done in the morning, how those numbers are put, how do you project, how do you understand? Numbers are used not only for putting your goals into picture, but numbers are used even for managing your business later on. So how do you want to be a successful entrepreneur? We said in the previous that to be successful, you need to know money. So understanding money requires a different mindset. It's called a business mindset. So when you have a product, when you're in a planning stage, when you create a product, when you're making it, and you are fine-tuning the product all the time, then you have a technical mindset, right? But to graduate and you want to make a business out of it, you have to change your mindset to a business mindset. So what is a business mindset? The business mindset is having an approach of profit. So any entrepreneur, yesterday when Usha ma'am was taking her class, her session, she was telling that you become any project or anything becomes a business only when you have a sale. Only when somebody pays you a consideration and buys your product, then it becomes a sale. Before that, it is just a project or just a product which you have created and which probably you are giving to your friends or neighbors to be used, right? So I'll go a step further. I say that when you sell your product for a consideration as a sale, you should have a profit motive behind that. So any entrepreneur coordinates the resources of land, labor, hires people to create the product, and with entrepreneurship for profit, then it is called a business. If you don't have the profit motive, if you don't have the thought that when I set up my business, I will focus on having profitability, then it is not a business. It is, you could be an NGO, you could be creating a product. It is something which you would be working for without a profit motive. Okay, so profit motive is the most important aspect of business. How did it? Okay, so coming back to the so when you make your business plan, you are trying to project how profitable you can be over a period of time, whether you will be having losses in the first year, whether you will be making profit, or when you can be profitable. So that helps you understand your business plan. Okay, so how does finance help you? Finance helps you, or the money aspect, the business aspect helps you in first, as explained earlier by Shravan, to set your goals. When you start out making your product and have a vision for the future, you want to be successful, you want to sell so many items of your product in a particular year, you want to reach a particular stage, but each of that goal has to be put in numbers and has to be projected over a period of 3 years or 5 years, where you will be, you can say, okay, at the end of 3rd year, at the end of 5th year, you will reach a particular stage and be successful. And for that purpose, what are the funding required? What is the amount I have to put into the business? What are the resources I have to bring into the business? All that aspects can be put in the basis of numbers. So first aspect where finance helps you is setting goals and strategies. Okay, so next aspect in finances, in a business, you have to understand how money flows. How money flows in a business, whereby you can use that concept to sell more products and create profitability in your business. Third aspect is control. How do you control your business with the help of numbers? So let's go ahead to understand that. So I've brought a basic idea. Many people don't understand, many students don't understand how a balance sheet works, how it is interlinked with profit and loss account and the cash flows of a business. So here I'll attempt to show you how these statements are interlinked and how money flows in the business to help you understand the concepts. Okay, so I've here brought a very basic balance sheet. This is a it is not a standard balance sheets which you'll get in a book or etc. So here I have, to simplify the concept, I've brought a balance sheet in a T format. Okay, so where does money come into the business? How does money enter the business? First concept you'll all have to understand is you are different, your business is different. You and business are not the same. Business is a separate entity, and when you become a promoter of that entity, you bring money into your business. So in a business, money flows into the business through your capital, which you probably brought in the first place. Then when you bring in other investors, they bring in money. And if you make profit, profit comes in, that is source of money, which I will explain as we go along. Money comes in also in the form of loans. Loans can be short-term, loans can be long-term. And money also come in through credit purchases. Again, this concept I shall explain. So, which are the sources of funds? How does money come into a business? So these are the ways a money can come into the business. Your capital, capital brought in by other investors. If you borrow money, that is also money coming into the business. And if you pay your creditors later, that is also a source of fund which sits in your business, can be used later. To explain that, if I buy raw material of, say, steel, if I'm manufacturing say thresher, agricultural thresher, and I have to buy steel for that, and I buy steel for, say, worth 10,000 rupees, and I don't pay my customer, my creditor, from whom I purchased immediately, I pay them later. That period for which I don't pay, that money is lying with me. So that's why we say that accounts payable is a source of funds. So when the funds come into the business from these places or these sources, where does it go? How does the money flow in the business after it comes in? Money goes and sits in the form of fixed assets. When you buy the machinery to produce your goods, money sits in the form of inventory. When you buy material to manufacture your goods, money also can sit in the form of credit sales. When I sell a good and my client doesn't pay me immediately and takes a few months' time, say 2 months, 3 months, that amount of time our money is locked up and it doesn't come. Okay, so that is also an application of funds. And the last is money sits as cash. When your money is lying idle, when you don't use it and it's in your bank account, it's in your cash account, these are also where the money is used. So this is how money comes into business, and this is where the money is used in the business. So anybody having doubts, please, you can unmute and ask. Have you all understood this concept, which I'm trying to explain?
Yes, ma'am.
Okay.
Can you brief about the part of long-term loans and short-term loans?
Okay, long-term loans are loans which you borrow for 7 years, 8 years. When ideally, when you buy long-term machinery, you try to fund it through bank loans, where the machinery is hypothecated and you get funds to buy the machinery. So these are long-term loans which you repay over a period of time with interest. So that will be, say, 7 years, 5 years, and so on. So short-term could be which you repay within a year. So you're a promoter, you would have brought in cash through your capital, but suddenly you find after 6 months that you didn't have money to pay for salaries for that particular month because the sales didn't go through. So what do? You dip into your personal finance and start paying salary for your staff. So that becomes a short-term loan for the company, because you paid the company that amount and the company paid the staff the salaries. And once probably the sales go through and the cash comes into the business, you will probably take back the money from the business. So remember, business and you are different. You're not same. So that aspect has to be kept in mind all the time. So let's understand one more aspect of source of funds. Shravan today morning has explained the profit and loss account in depth and made you understand that. But I want to tell you what happens to that profit which is left at the end of the year or end of the thing. So I've brought a simple example where you have a revenue of 1,000 rupees and cost of goods and services is all the expenses that is incurred to make your product ready for selling. Okay, it's only those expenses that go into manufacturing the product or the product which is ready to be sold. It doesn't include your administration expenses, selling expenses, or other general expenses. So that is the gross profit. So to repeat, when you have revenue and from that revenue, you reduce only those expenses that go into manufacturing the product or giving a service. That is called, after reducing that, what amount is left is called gross profit. And from that gross profit, when you remove selling and general expenses, administration, selling and general expenses, you get cash operating profit. Okay, so this is the operating profit after all the expenses are removed from sales. This will include the administration expenses, selling expenses, and any other general expense. So this is, again, to repeat, cash operating profit, which is 400 rupees in my example. And from that amount, when you remove depreciation or amortization, you get the operating profit. So what is depreciation? You have bought a machinery to manufacture your goods, which is sitting as fixed assets here. These fixed assets last a long period of time. You would have bought a machinery which you assume is going to last you for 7 years. Okay, but after 7 years, you'll have to replace the machinery and buy a new one because this will go defunct. It won't work anymore. So for that purpose, what is done in accounting is that you depreciate, you take a portion of the amount you spent on the fixed assets and charge it to profit and loss account here as depreciation, so that over a 7-year time frame, the machinery value becomes 0. And hence you can buy a new machinery. So when you're removing a particular amount and charging into profit and loss account, is cash spent? Any answers? When I do this, what I would call as an accounting entry, when I remove 1/7 of the value of fixed asset and remove it from my profit, does cash get affected? No answers. Okay. Cash doesn't get affected. The cash doesn't go out of business. When did the cash go out of the business? The cash went out of the business when I bought that fixed asset. Can you understand the difference? When I bought the fixed assets for, let's say, 1 lakh in the beginning, I spent 1 lakh and the cash went out. But when I remove, say, 10,000 rupees from that asset in the balance sheet and reduce my profit every year so that the machinery lasts for 10 years, no cash goes out of the business. The cash is still in the business, but my profitability has come down by 100 rupees. Okay, so this is a difference which you'll have to understand. So this is the operating profit, but my cash operating profit is higher because by removing this amount, cash doesn't move out. When will the next installment of cash go out of my business for fixed assets? When after 10 years, when the value of this machinery becomes 0 and I buy new machinery. But we can't wait for that long. We have to, in an accounting parlance, say, reflect the reality of the business, whereby we reduce 1/10 of the value from fixed assets and charge to profit and loss. Okay, so now we are come to operating profit. If you borrowed loans, long-term, short-term, you have to remove it from your profit. So you'll have interest, which is reduced. Any questions? Okay, going forward, after you reduce your interest, you have earnings before tax, you pay tax, and you get 100 rupees as your bottom line or your profit or your net income. The terminologies differ, but the value is the same. So you're left with 100 rupees after the end of the year in the profit. Remember, profit and loss account says what happened in a period of a year. Say 1st April, say 22 to 31st March 23. So it's a statement which says what and all happened in your company in a period of a year. Okay, when you go back to balance sheet, it says what is the position of your company as on a particular date. Okay, as on 31st March 2022, this was my status, that I had so much loans, I brought in so much capital, and my net profit is so much. So that 100 rupees which you created throughout the year comes and sits in the balance sheet at this particular place, at profit and loss. Okay, so if you had created profit in that particular period, your your source of funds will increase. Okay, but if you had created loss, then the source of funds will decrease. It's as simple as that. So the first three items, your capital, your other investors' capital, profit and loss, together becomes the shareholders' capital. Okay, so so you could ask me that many companies continuously make losses. For example, Amazon, it was running on losses for a very, very long time. The capital gets reduced over a period of time. And unless you're bringing in more capital, your business cannot survive. So it's as simple as that. Profit is a source of funds. Loss is an expense. It reduces your funds. So that is why there's a need to focus on profitability. That is why you have to get a business mindset where the target which you have in starting your startup or any business is not doing things for free or coming with your best product, best version of your product. No, it could be the medium version of your product, but it should sell. I think Usha ma'am made it very clear here. The people should need your product. They have to pay money, pay consideration to buy your product. Okay, so the final aspect, the business mindset, when I say this is what it is, that you should have a profit motive in your mind. The profit which I'm talking here is extremely important because that's how the business will grow. That's how the business will survive. If you constantly make losses, you will erode your capital. Unless somebody is going to give you more money, you have to shut down your business. That is why the importance is given to profit. And that's why profitability motive is required for every business. Any questions till now? Okay, so going forward, we'll look at, I'll try to explain accounts receivable and accounts payable in this slide. Okay, so I showed you till now how money is moving in a business through balance sheet. That is how money came into the business and how you used that money to buy various things, buy fixed assets, which helped you create a product. You bought raw material to make the product, and finally you sold the product and made profits. Okay, so that's how the balance sheet shows. Now let's focus on the current assets and current liabilities part of the balance sheet. So you have cash. Let's see how cash flows in a business in a cash flow perspective. Okay, so you have cash. When you buy cash purchases, the cash is spent. Whereas if you are not buying on cash directly and your suppliers giving you credit time, then the amount is not paid immediately and it is locked as accounts receivable. The amount for accounts receivable is paid after a gap of 1 month, 2 months, depending upon how much time your creditor is willing to give you. But the later you pay, the more money is there in your business for other expenses. You can manage the cash flow in such a way that if you delay the payment to your creditors, you have more funds in your hand for a little more time. Of course, it does get payable after some time, but it helps you manage the cash flow over a period of time. So once you've purchased your raw material, it goes and sits like inventory in your business. Okay, the inventory can be raw material, it can be work in progress, that is half completed product, it can be finished goods, which you have completed but you have not sold. Okay, so money is locked in. So here we are looking at money flow. Okay, so money can be locked in as inventory. You have purchased the item, so the item is sitting with you as inventory. Once the product is complete, you sell it. If you sell for cash, the money is received by you immediately, so it goes to cash in the balance sheet. But if you sell it for credit, then money is not received by you immediately, and it takes time to receive the money. So here, should I sell my products in credit or not? Any answers?
Yes, ma'am. To retain a money till some amount of time so that we can spend it on different things, we have to give it on credit, I guess.
Okay, so you have to, because your customers, if your product sells more because you're giving them credit, then obviously you would like to sell on credit. But then how do you manage the cash flow? The best way to do it is the credit terms should be such that it is comfortable for you too. You collect the customers, collect the receivables quickly so that the cash flow is there constantly in your business. Remember, these are the places it is getting locked. Money is getting locked as account receivable. Money is getting locked as inventory. The L which I've put here is where I would call it as leakages are happening. Supposing you bought a raw material anticipating, let's say you have 3 product lines. You bought raw material for all 3 product lines, but only the 2 product line could be sold. Third, you couldn't sell, and it is lying with you. So the money is locked up, and unless you sell that product, that money doesn't come back to you. When the money comes back to you, what do? You buy more raw material. So it is a cycle. So when I say L here, it means leakages or money is getting locked up. So these are the places as an entrepreneur, you have to focus to say that it's more efficient and money doesn't get locked up in these formats. Okay, so this is the cash conversion cycle, which I would like to explain. It's a little complicated for students of engineering, etc. But something which, if you understand, it helps in your business. So here I was telling that money is getting locked as inventory. It is sitting. Money can get locked as account receivable, and money is delayed payment happens due to accounts payable. So in case of payable, it was positive because you didn't pay them. Cash is lying with you. In case of receivable and inventory, it is negative because your money is getting locked up. So inventory days plus sales days minus payable days is cash conversion cycle. Okay, this is the formula. Let me try to explain the concept. When a cash conversion cycle means how fast your cash becomes inventory, becomes sales, and comes back as cash. Let's take an example of a restaurant business. What does a restaurant owner do? Let's take a restaurant which is a small one, maybe a Darshini. Okay, the owner probably goes in the morning at 5 a.m. and buys all the vegetables and flour, etc., comes to the restaurant, manufactures or cooks his food and serves. Let's say it's a breakfast restaurant of dosha or upma, so on and so forth. So by 5 o'clock he goes, purchases all the items. Let's say 8 o'clock he cooks all of them, and by 9 a customer comes, eats, and most of his product is over. So how much time do you think cash was locked up? Any answers?
from morning to the time where the customer came and ate the product, because after that they paid the bill and they get the money back.
The cash, excellent, awesome. So you've understood the concept. So the money was locked up from 5 a.m. to 9 a.m. That's it. Can the restaurant owner take the same money, go to the market again, cook the lunch and serve the lunch for the customers? Theoretically, yes, right? So the money came back to him by 9 a.m. He can theoretically go again to the market, buy all the ingredients again, cook the food again, and by 2 o'clock, his money will be back because all the customers would have eaten lunch. So this is a business where the cash gets converted to cash very fast. Okay, but let's take a contrasting business. Now, example, last year's success story of a groundnut thresher, a person who manufactures an equipment with which groundnut groundnut grown in the fields get threshed and you get the groundnut output. Okay, in this case, you have a thresher, you have to manufacture the thresher. Probably manufacturing of the thresher itself takes 3 months. And the selling of the thresher happens only in the season when the groundnut is grown. And that is the only time he can sell and then get the cash back. So assuming he manufactures the thresher for 6 months and sells the thresher for 2 months. So overall, the raw material which he purchased in January, okay, can be converted into sale and the cash comes back to the person only after 6 + 2, 8 months, let's say August. So in this case, lot of money is getting locked up for a lot of time. So intuitively, I'm sure you all understood that the restaurant business needs lesser money to conduct the business because the same money he is circulating again and again. Whereas in this case of a groundnut thresher business, the money is getting up for a longer time. So the capital required for that business is more. So this formula which I'm trying to explain helps you calculate that. Here I'm adding the inventory days and sales days, minusing the payable days to get the cash conversion cycle. So let's take an example. So here I've got Garfield Cash Foods Limited produces 12,000 units of cat food every year. Okay, on an average collects debtors after 45 days. Debtors is after sales. An inventory for holds inventory for 75 days and pays creditors back. Creditors are your suppliers back after 30 days. So totally he spends 12 lakh of rupees annually to make 12,000 units of cat food. Okay, so let's see how much money is actually required to produce the product for a year. Okay, so remember 45 days of debtor, 75 days of inventory and 30 days of creditors. So what is the cash cycle here? I add the debtor days, I add the inventory days and reduce the payable days. So 45 plus 70 minus 30, 90 days or 3 months is where my money is getting locked up into the business. Okay, so if money is only locked up for 3 months, we have 12 months in a year. So I can use the same money 4 times. In the restaurant business, it was if you had 365 days and you used it up of, you could recirculate 3 times in a day, then the turnover was very high. But here it is 3 months and 12 months in a year. So 4 times the same money can be recirculated in the business. So if I required 12 lakhs for the full year to produce 12,000 units of goods, which I'll be selling, I need only 3 lakhs. I don't need 12 lakhs. So this is how you calculate. So let's go back. So why these numbers are important? Why 75 is important? Why 45 is important? Can you tell me? Anyone? First of all, have you all understood what I'm trying to say? Any answers? Or should
Can you repeat the question, ma'am, please?
Okay, question here is why when you understood that 90 days is my money is getting locked up and 3 months is a cash cycle. And I can circulate the money 4 times in a year. And if I circulate the money 4 times, I don't need 12 lakhs. I need only 3 lakhs. How important is the number 45, number 75? Should I reduce it? Should I increase it? Or what about the number 30? I'll go back to show you what are those numbers. So it says that what I'm trying to explain here is debtor days is where money is getting locked up, right? And if you reduce those 45 days to say 35 days, and if you reduce the inventory days from 75 to say 60 days, then the capital you require will not be 3 lakhs, it will be much lesser. I hope you have understood it now.
Yes, ma'am.
Yeah, so when you require lesser capital, if you reduce the time credit given to creditor to your clients, and if you need lesser capital, if you don't lock up much of your money in form of inventory, wouldn't you like to try? Because that is how you save money. If you borrow money, you'll have to pay interest. So going back to balance sheet, where does the money come from? From these sources, right? If you can't bring in capital, your other investors are not giving you money, you will have to go and borrow. Borrowing increases the cost. So as an entrepreneur, you have to focus on how you can run a lean, mean startup. I would put it that way. So when you say lean, mean startup, you have to see where are the ways you can reduce the usage of money in your business.
Excuse me, ma'am.
Yeah. Tell me, yes.
On what basis can we decide our credit period?
Yes. Credit period is usually decided on the basis of how it is decided on the basis of experience. If your product is so good that, you know, people want to pay money ahead and buy your product, then it is so good. For example, let's take Hindustan Unilever. Hindustan Unilever collects money in advance from its clients to supply goods because the product is in heavy demand. So they have what is called negative cash cycle. They don't have to, you know, collect the money later, they collect the money in advance. But it all depends upon whether your product will sell more if you give time, or will it sell more if you don't give time, right? So that is a decision as an entrepreneur you have to take, that how much credit period I'm willing to offer to my client so that I get more clients. Between cash sales and credit sales, the reason we differentiate it, the reason we give credit is to improve your sales, to sell more. If you're able to sell enough quantity without giving credit, you don't need a credit period. I hope I've answered your question.
Yes, ma'am.
Okay. How much time? No, how much time?
It's up to you.
Yeah. Okay. So to wind up, so see, when I said as an entrepreneur, I have told these are the things you have to focus on. So how do you focus on? Initially, I told you finance can be used for projections. Finance can be used to understand how balance sheet, profit and loss account work, and also for measurement and control. How do you control your business? Through finance. So you can keep a dashboard like this as an entrepreneur and find out how many days of sales are outstanding, how many days the inventory is pending, how many days payable are pending. With the example I've given now, I explained to you why these figures are important. So daily morning, you open your laptop, you see these figures, you know, okay, hey, these are getting, you know, overdue. I should start collecting it from my customers today. Or if your inventory days are showing higher number, then say why it is getting locked up. You could go and inquire to your staff that why inventory days are showing higher than normal. What am I supposed to do? Because money is very, very much a scarce commodity. You need to understand how to use it optimally. So these are dashboards. Management dashboards are a method of controlling your enterprise, helps you run your enterprise more efficiently. This is one dashboard which I bought. There is one more dashboard which is called KPIs. This is a common terminology today, key performance indicators. So you could have a dashboard like this. Again, first thing in the morning, you come to work, you see these dashboards. You say, okay, my revenue target is so much. I've achieved only so much. My margin is this now. Should I increase it? Should I decrease it? So those kind of decision makings become easy because you have this dashboard. Going back, I was telling you, finance could help you in projections, that is setting goals and strategies. Finance can help you in understanding the cash flow in the business, and finance can help you control your business more effectively. Okay, one more concept I would like to explain before I close this, which is return on equity. If you remember this profit and loss account, we said 100 rupees is what I made, right, in the full year. So if you're making 100 rupees of net profit for it in your company, the funds brought by you and your investors are 1,000, then the return you made for the full year on equity is 10%. Okay, so this return on equity is what you and your other investors are getting from the business. Okay, so this is a very important figure because this is talking about how much profit are you and your investors getting back from the business. So I'm relating it to the capital you're seeking. You are going out to angel investors, VCs, seed funds, investors, and asking for money. If you're making 10% return, would they give you money? That's my question. Yes or no?
No.
I'm getting a no here. So students, is it a yes or no?
No.
Why? That person.
Because,
yes, please.
Because in most of the case, 10% is very less on the return what we get. And we get more return on the different types of investments. So they don't tend to put in that kind of business.
So you can get 10% in fixed deposit. Why should an investor take a risk with you? Right?
Yes.
So,
yes.
So how much, so what is their expectation? Raising money is one part. How fulfilling their expectation is the other part. How are you going to fulfill? Unless you have a projection, unless you have an understanding how profit is made, unless you know how to generate profit, no investor is going to stick with you, right? So understand this aspect that when somebody is giving you money, there is an expectation from that money and you have to fulfill that expectation. This chart also shows you the same thing. The expected return from a startup is much higher than stocks, corporate bonds, or even government bonds. So over a period of time, the expectation is higher and you have to see that you're able to fulfill that kind of expectation. And if you can fulfill that kind of expectation, money just flows into your business. Whereas if you can't fulfill those expectations, money does dry up over a period of time. So remember this concept of return of equity and how you have to try and increase the return on equity for yourself and your investors. Okay, quickly to the slide. When you're giving money, when you're giving a stake to your person who's giving you seed capital, or giving a stake to a person who's a VC who's investing in you, each time your portion of the capital is getting reduced. You start with a capital of 100, which is for you. After the seed round, probably it reduces to 85. And after the angel round, probably it goes down to 70. So each time you go to investors for money, your portion of capital is getting reduced. So ideally, at early stage of startup, you shouldn't dilute your capital so much. Whereas at later stages, as the valuation of your company increases, you should try to dilute more, right? The early stages, better you plan your business well. That's why we have had so many sessions for you to teach you how to create a business plan which is realistic and good. And so that you don't run out of money quickly, don't have to dilute your capital quickly. Stages. And I think I will close this because I'm running out of time. This is how I'm summing up my full session. Thank you so much. Any questions are there? We'll take it up after the next session. Thank you. What's it? I thought I ran out of time. Yeah. Yeah.
Yeah, thank you, Ms. Shubha Ganesh, for your exhaustive insights on the financial planning for entrepreneurs. We shall be having a separate session on the question and answers in a little while. It's my pleasure to introduce our last speaker for the day, Mr. Jagat Iyer, who would be addressing us on the factors that make a startup a successful unicorn. Mr. Jagat Iyer is a founder of and CEO of VidPhone, which is video customer engagement platform, and is a new normal in the video first economy, which helps in growing your business. He has a rich experience in many companies like TATSTAT Corporate Solutions Private Limited, Keystone BSS Infracon India Private Limited, Shobha Developers, and Aviva PLC. I welcome Mr. Jagat Iyer to make his presentation for the day. Thank you.
I'm good as long as it's audible. No, I'll leave you. Yeah, this mic. That's the camera. That's the audience. Yeah, yes, that's right.
Very good afternoon to the audience. I hope I'm audible. If somebody could say I'm audible in the audience.
Yes, you're audible, sir.
All right, thank you. So good afternoon. While we wait for the presentation, okay, it's up. I don't know how to follow that. That was an excellent session. Let me know when I'm ready. Yeah. Shall I do it? Okay. Yep. You okay? Little to the right, I think. Okay, so that's good. Shall I start? Yeah. So thanks firstly to the FKCCI team and everybody, such an amazing job. So many startup plans, presentations, and so many ideas, right? I think it's phenomenal. So thanks, first of all, for the opportunity to share some notes, right? So my name is Jagat. I'll talk a little about myself, but this is my topic, right? So that's the moment I got this topic, I said, look, I'm not technically or certified as a unicorn company. So I don't know whether I should be speaking about it. But then, Lakshmi, who was kind enough to get, said, no, you have to share your ideas on what you have learned. And, because we're running multiple businesses today. So just wanted to share my learnings. This is not like a how to build a unicorn, because firstly, it's a mythical creature. So it's like going after a mythical land, right? You go to that land and you realize that there is nothing there. So it's not really about a unicorn, is just more of a metaphorical concept to reach some milestone, right? So let's keep it that way. So a little about me, right? So yeah, right now, after 12 years of building, the company, I think the focus now is really for me to mentor a lot of young startups, right? And the goal, I like to set audacious goals. And the goal really is for me to mentor 1 million Indian startups and to help create hopefully hundreds of unicorns, right? It could be thousands, but there is a way in which we are doing this. This may seem crazy, but that's all we do, right? We just do crazy things. So we give this a big shot and let's see. Already we have 40 plus startups that I mentor formally and informally as well. So informally there are more, but really across sectors. So I just share what I've done in 12 years through social commerce in 2010 to digital transformation to video chat and now blockchain. I try and share what we have learned, in this whole journey. So, okay, this is. So how do I stop halfway? It's a PDF, yeah. Is there a way for me? Can you just scroll it up slightly to this slide? The previous one? Yeah. Start. Oh, Good. Thanks, Saku. Kannada. So just want to know if everyone's okay with English. I know this is FKCCI. I'm a proud Bangalorean, born brought up here. So Kannada al matadbekandre I'm more than happy. So Tamil also is okay. I'm Jagat Iyer. So Tamil best that's fine. Any more? Malayalam, I don't know too well, but anyway. So let's, so feel free, right? Don't let language be a barrier. Some of these terms are, of course, made in English. There is no word for unicorn in Kannada, is there? Madvek first, now on coin Madvek, unicorn. So anyway, so the topic for today's agenda, right? I just have about 45 minutes, maybe now 35 minutes. But let me run through what we want to do. So first, I want to deep dive into the topic. Now, this is a very critical topic. I think it's one of the most important. I wouldn't say the most important, probably a small edit. It's very, very important topic, right? So what actually goes into making a successful startup or a unicorn? The factors and the action points, right? So what out of 45 minutes now, I would consider this training to be a success if after this training in 45 minutes, all of you can go back and have something that you can do, right? It's not just something that you listen to and you forget about in the next class. If you can go ahead and actually do something, I think it's useful. And any additional notes, I'm happy to share some things and some notes with some audience here as well. All of you also have a lot of experience. So we could discuss some topics and a Q&A, right? And in the end, you can communicate where you may need help. So I think happy to, in the end, kind of facilitate that. Right. So I again need some help in this in between. Yeah. So let me just break down the topic itself. So the key things here, of course, factors to make a startup unicorn or a successful unicorn. So we have three main words there. Of course, it's the factors, but we have startup, unicorn, and successful, right? So these are the three words that we need to kind of delve into. So a question to the audience, right, for you guys. Let's say that one of you have a friend who's opened a restaurant. Is that a startup? Are they on audio, video? You guys can feel free. Okay, cool.
No, sir. Restaurant
Nice,
is not a startup.
see them. All right, good. I can see myself. So if any of you feel, which one of you, how many of you think that a friend starting a restaurant is a startup? Please tell me yes or no. Startup, yes or no?
No.
Yes.
No.
Is that good? That's it. What else do other people think? How many people do we have here? We have 102 participants, so 102 teams. So that's a lot of people. And I only got 3 responses. Is it lunchtime?
No.
No. Is a new restaurant a startup, guys?
No, sir.
Okay. So typically, okay. I would like more response there.
It is.
Okay. So, right. No, I'm just trying to get the numbers first, and because I don't have much time. If everyone's reason becomes tough. So, okay, let me tell you that a startup is not, a restaurant is not a startup, right? And let me tell you why. When you define a startup, and it's not my definition, these are all things already defined in the ecosystem, it has to be tech enabled, right? So if it's not tech, it's not a startup. It's as simple as that. It's a small business. What your friend's trying to do is a small business. It's not a startup. A startup is designed to scale at a totally different velocity. There is way different risk. There is way different, way to play it. If you had a restaurant and you had an app that actually brought in users and served your customers, then you could be looking at a tech startup. That's what, like, for example, a Cult Fit does, right? So Cult is actually a gym. So a gym by itself is not a startup. But when you put a gym on an app, and then you can track, you can gain like users and you can serve them completely on the app, then it becomes a startup. So let's understand this. And Steve Blank's definition is, I think, the most apt definition, where he says that, and guys might want to make notes, right? So the idea of a startup is not to be a startup forever. So first of all, understand this, right? You don't want to be a startup forever. You want to be a company. You want to be an enterprise at the end of the day. So Steve Blank says a startup is a temporary organization, right, that is created to deliver some value in a sustainable and scalable way, right? So this is how he defines startup loosely. So a startup is a temporary organization. It lasts maybe 3 years, 4 years. And then ideally in 6 years, you want to go public, you're then not a startup. So I feel, it's very weird when I hear people tell that Flipkart is a startup, or even Paytm is a startup. They're not startups. They're public companies or part of public companies. So they were startups. So this is the whole idea, right? So in a startup, you want to have something that's a temporary organization to build something that is scalable and sustainable. So then it becomes an enterprise, and your goal as a startup founder is to build an enterprise. It's not to be a startup for a long time, right? So that's the first thing. And I think there's already great literature, and I only recommend you guys to read Paul Graham, obviously to read Alexander Osterwalder, Business Model Canvas. I think you guys already seen that. And then of course, Eric Ries, Lean Startup. So this gives some fundamentals on how to approach building startups, right? It's very different from an MBA where you have like case studies of established big businesses. This is about 0 to 1. It's about, setting up your tea stall and then building an app around it and then building a tea community around it, right? So it works like that. Now, the second, so this is startup, right? So understand that it's temporary. $1 billion is nothing when you look at a large company. A big, public companies are worth hundreds of billions, if not trillions of dollars today. So $1 billion is the first step. Now, the word unicorn, right? So unicorn is mythical, but for the sake of putting some kind of a benchmark or some milestone in a growth of a journey, they say, okay, $1 billion valuation. So what does that mean, right? So that means market cap or the total number of outstanding shares into the, the share price at the last round is giving you the size of the company. Now, a lot of companies, they become unicorns momentarily. They make an announcement, and then typically what's happening now is you have a lot of layoffs, a lot of negative kind of news, which obviously means your valuation has dropped and you do down round. So you're like a unicorn you're like a flash unicorn, right? Now, the idea is to build things of substance, which means that if you break down what a unicorn is or $1 billion market cap, it would be typically $100 million revenue. So now that is more tangible way to approach business at a, let's say 10 times price to earning, right? So you make 100 million annually. You can say that 10x that is approximately a valuation. Now it depends on your industry and where you are and everything, but typically that's like a ground rule, right? So it gives you a lot more tangible thing to go after. If you're doing 100 million revenue, nobody can dispute that you're a unicorn, right? So it's as simple as that. And now we get to the ways to 100 million. I'll show you a sketch. Again, I have not done that. I'm just putting together some great work by a lot of folks. And now we come to the third part, which is success. Now, coming in the news or claiming that you have done this round is not, I think, success. Most people should not aim at this instant glory kind of, stuff. I think it's good. It's okay. I'm not against it. But I think if you really want to be an entrepreneur, you must understand entrepreneurship is maybe a 20, 25, 30-year career. And if all you want to do is come in the news, there are many other ways to do that and faster ways to do that, right? So maybe that's not the best way to approach it. It is important to get PR, but I think PR should not be the end of why you would do things, right? So success, I'd like to define in 3 ways. So see below. So secure, scalable, and sustainable. This is how I define in my way what is success. So at the very first level, you see that most companies today, and the best companies, biggest tech companies included, are not what I would associate with the word secure at all. And so in my view, the companies that today, especially with the massive kind of involvement of people in blockchain and Indian government's own views and the way they are directing all parts of the ecosystem, be it, in terms of finance, be it in terms of the political system. So I think security becomes very, very fundamental. And this is very unique to India's ethos and the way we build organizations. We are not generally a country that's too probably gossipy, right? So we like to gossip, but we like to maintain a lot of levels of privacy by default. Now, I say that 2 years of video conferencing has done more harm to security than 10 years of social media, right? And that's very scary. That's because of, it's a growth at all costs kind of approach, which is definitely not sustainable, right? So the first thing would be to have a secure kind of environment where you're not putting your users at risk, right? So that's the worst thing to do. If you fail your startup, that's fine. But if you take down 10,000 people who have all lost 10,000 rupees, now that's not a good idea, right? So firstly, think always protect the downside and build from where you can actually not lose anything than to gain anything, right? So the next thing is scalable. Now, this I think companies not only in India, but worldwide have figured out at some level. We understand what's growth. We know how we can work CAC to LTV ratios. But I think in terms of scale, what we actually mean is to build technology architecture that scales. Even recently, you'll see that a lot of the CDNs were down, right? So a lot of the sites went down recently because of these central point of failure kind of stuff. So we want to be able to build scalable things, not only in terms of customer acquisition and that, but also in terms of technology, where we go to peer and are building more kind of scalable systems, right? And sustainable. Now we are far away from building a sustainable planet, right? Very, very far away. But sustainability starts with trying to think about your business. Will it last 100 years? And can somebody in the future actually take it up and continue it, right? So that's very important to ask in terms of sustainability. If you build companies built around fads, I think you may get lucky, but you definitely won't be building an institution, right? So when you build a startup, the idea is to build an enterprise, and the idea is then to build institutions. So can we go to the next slide? So this is how I quickly want to break down this, the topic itself, to give some clarity on it, right? Right. So this is again, so you can just go down to the source. I want to quote the source. I don't want it to sound like it's mine. No, to that one, just little up. Yeah. So this is all by Christopher Johns. You can go and check his blog. This is not mine. Firstly, I didn't come up with this genius stuff. So you can just go up a little bit. So this is the simple thing, right? Now we get to the next part, which is to build $100 million business. Now to build $100 million business, and I'm just saying $1 million simply because Unicorn itself is $1 billion. Otherwise, I'd say 7,900 crore company, right? But since we are using that terminology, we keep USD. Now, these are the only ways to build a $100 million company. And it's quite simple. We say you either go after flies, and this is again, to all due respect to users and people. We're just using an example here, right? We're not saying that people are flies. I know this is being recorded. All people are elephants, right? We have nothing to do with that. And this is not even said by me, so I'm good. So right, so you basically go from flies to elephants. So let's look at a company like Facebook, right? So Facebook makes money by, how much do you pay to use Facebook? You don't use anything, right? It's a free product. But how does Facebook sustain? They sustain by selling ads to businesses. And typically, the kind of numbers, those into digital market will understand, we'll talk about things like CPC, cost per click or cost per impression, cost per actions. And these are all typically like, 10 rupees, 20 rupees, 100 rupee worth transactions. And when these, when 10 million people give the business $10 over the year, you have a $100 million business. So these are companies, consumer companies, we call them, like Facebook, Instagram, and Snapchat, and you name it, right? So then you come to the next, where you have 1 million consumers paying you about $100 a year. So this is like typically like $10 a month, $9 a month, right? Pricing. Typically consumer SaaS, prosumers, right? So people who are small businesses, home-based stuff, freelancers, typically they can afford like a 700 or 1,000 rupee product per month, which gives something like this, okay, approximately. So this is the next category where we say you're hunting mice. So you go from flies to mice. Not that I encourage hunting again, so. But next you go to the small businesses. Now this is a very dicey spot, and I recommend no one, you should never be here. This is really a death trap. It's the middle of nowhere kind of thing, where you're selling to 100,000 small businesses at about, let's say, 80,000 rupees per year, right? That's about 7,000 odd per month. This is a very tricky spot. $100 a month is very weird spot, because you're not in the enterprise and you're not in the consumer. So typically that's very tough. Like I don't recommend anyone to come here, right? And then you have and so there, I don't know, it looks like bunnies or something, whatever. So then you have reindeer or deer. So you next hunt deer. 10,000 customers paying you about 8 lakhs a year. Now, typically you're getting into enterprise, but not yet fully enterprise. You're in, your customers are typically big businesses who can afford to pay you 8 lakhs, or really rich people, right? So one of the two things. And the high end of the enterprise, this you can think of as where, Palantir operates, or where even a TCS and stuff like this. I mean, TCS is not really a startup, but let's say a B2B company, Workday, or any of these, right? So any B2B company, typically doing enterprise, above 80 lakhs a year, 1,000 customers. That's what you need to get to build a unicorn. So this is, I think, the way that you can also take screenshots or whatever, or refer the blog. So this is your number of customers. The smaller the size of the customer, the smaller the ticket size, the more number of customers you need, right? So you need 10,000 customers paying you $10, 10 million customers, and then that's in thousands. So, and then the ARPAs, average revenue per account, or ARPU per user, whatever you call it, right? So that's the ticket size, and that is the number of customers. So you do a math and you see, and now the point of this is to figure out who you are and where you want to kind of build the business, right? If you're someone from college, like when I was 22, I started and I had to do a consumer app. I didn't know anyone in enterprise. I didn't understand B2B selling, forget consulting or solution sales. We had no idea about this stuff, right? So all we could do is really build an app and hope that people came. So that's typically a consumer app. So if my recommendation is, typically when you don't have the industry connects or the knowledge, is that typically you must all, and these are all students, right? So I think all of you should just focus over here. Forget about all this stuff, right? Typically, I'm saying for the beginning of your career, just look at building, because you look at all the apps, right? You look at Google, you look at Facebook, you look at Flipkart, everyone's below 30, and that's the way it goes, because you know that user. You always look to build things for your kind of demographic. This is the best way to do something, right? Typically. Now, if you build for other people who are in college, now you can think that's how every company really started. Even Google was a college project, was a PhD paper, and then all the apps in the valley and everything. So I would say this is a really good spot for most students. But if you're somebody who's 40, 45, 50, you know people, well, I say know people because you're in India, but more you have industry knowledge on a particular domain, typically you want to be doing enterprise, because that's where the real money, you could say, lies. So yeah, this is a quick summary on how you can build your business. Maybe if you have some particular passion, let's say you're a golfer or you're a cricketer also, when you're doing consumer, then you can look at going a kind of enterprise and building an app for cricketers where they can practice with the kind of stats and everything, right? So that becomes more of an enterprise sale. But typically you want to be looking at, how can I get people like you and me to use the app, and kind of what is that one habit I can make them do every day, right? So we can go to the next slide. Yeah. So I like to simplify life like this. It's not an Indian concept also, but so they have the concept of yin yang, where typically most of life is duality, right? You have two things to handle, and it's like day and night or black and white or whatever. So typically in a startup, there are two things you need to focus on: is the internals of the startup and the externals of the startup. This is how I like to break down things. And you handle both in different ways, right? Internal things are to be handled in different ways, and external things that people or customers are in contact with is totally different, right? So I just like to simplify it this way. You can go to the next one now. So here is the thing that I'll spend now maybe 15 odd minutes, right? So this is a quick mind map on the success factors. So this is like the most important thing. Can I get some water? I hope we're making sense so far, guys. Is it useful to you guys? Can I get yes, no?
Yes, sir.
If you want to hear,
Yes,
more, bring it on, bring it on. Can I hear like bring it on if you guys want this?
Bring it on, sir.
Thank you. I haven't spoken so much in a while. I'm just joking. We are always exchanging ideas, but yeah. So here are the things, right? So think of this. I want to keep it very simple. Now, if I really want to mentor you guys, it's going to take process and months and stuff. But if I just need to give, I just have 45 minutes. So in the interest of time, we just want to give it at a very high level mind map. So then you can go into the details. I'll just give you some points, and then you can go and do research on each one of them, right? So let's look at it that way. We'll start from the top. This is the most important thing. How do I put this, right? So typically, most people in India, at least, have been conditioned to do jobs, right? And with all due respect to employees and everything, but do employees really, apart from, if there's no founder, can the employees build the company or the startup? I don't think so. So we must understand that for you to be a good founder, it has to come from within. It's not about something that's hot or something that's good, some market that's good, or greed or even frustration with your boss. or frustration at the system. It should not be anything to, if this is why you're doing a startup, like you should not do it. The real reason you should be doing a startup is if you can really add value in something that you think you know or you want to know about, right? And from school, we have all been trained in, at least in most, houses, what I call negative motivation. It's like, if you don't go to school, you can't write the exam. If I don't go to office, I will get fired. If I take leave today, I won't get my salary. So, and it's okay. I'm not biased against the system that way, but I think we should, as entrepreneurs, when you're a boss, effectively, who's going to tell you what to do, right? Really nobody. And that's the thing you must understand, is that it really has to be an internal thing. And it really is to do with this 5-letter word that I call dream, right? What really is your dream? And it typically has to be beyond thinking about this unicorn and stuff like this, right? It has to be more directed towards what kind of people do you want to be impacting or influencing in your life, right? Every product serves a particular audience or people. So first you think, what kind of people I want to help in my career. And that could vary over time, but when you're doing something at one time, you could be focusing on one. So the first thing I say is the dream. And let's say you were in school, or when you were not even in school, when you were a small boy. If I asked you, what is your dream? What would you say? Now, even people here can answer me, right? So if I asked you, when you were really young, what is your dream?
Maybe to be a soldier or something.
Soldier. Then what else do we have? What about you, madam?
It was to be a scientist.
A scientist. Right? So I wanted to be an elephant. People want to be Superman. I hear I want to be Superman. I'm talking when you were a kid, not when reality set in and you started figuring out these things. When you were a small baby, it's like, Dad, I want to be an elephant. I want to be a tiger. I want to be, because your mind has no limits over there. You can think that you can become anything. And then slowly reality set in. Yeah, that's again more realistic. A lot of people have that goal. That's a good one. But think about something like an elephant or a dinosaur or something, right? I want to be a dinosaur. I want to be a T-Rex, right? So that's actually what we get from kids. And that's because they're uninhibited in their thinking, right? And then reality sets in, at around 22, 23, we all get jobs. And then we go to work, come back home. Go to work, come back home. Go to work, come back home, right? 40 years, drop dead and die. So reality sets in and then you're like, absolutely, right? And typically when I'm just going on the road and I stop someone and say, "Sir, nim dream yenu?" I'd be like, what's going on? He'll be shocked. He won't really even believe that someone asked him that question. But, and he'll think I'm mad. But think who's mad, right? Am I mad or is that person mad? Who does not even have a dream why he's living his life, right? And so this is why I think it's very important to have a very, very sound dream, because startups are hard. And really, like what Steve Jobs says, the only reason you will do something when times are bad is if you really love doing what you do, right? Because if you're doing it only for the money, then many times in startups, you don't make money for a while, you make money a lot of times. I mean, no, it's actually the other way around. You don't make money a lot, you make money sometimes. But you have to understand that, yeah, I mean, these things are critical to kind of move, right? Having a sound dream. Let's say, for example, your friend started the restaurant and the friend took a loan to start the restaurant. Now, the restaurant operates from, let's say, 10 in the morning to, how long can you open a restaurant? Maybe 10 in the night. And at 10, 10:30, the police are coming and everything, and they're shutting everything down. And then the shutter, he's putting the shutter. Suddenly, there is a group of about 20 people who are coming to eat. What do you think your friend will do? Will he shut the shutter or will he open the shutter immediately? He'll be like, immediately, he'll open it back, right? And then he'll say, no, I was just testing the shutter, please welcome, come inside, eat, right? Why is he doing that? Is it because he loves to serve food to people? No, it's because he has to pay back his loan, right? And that's what gets him to actually work. The fact that he has to loan to repay is what makes him go that extra mile. Now, suppose you don't take a loan and you just put up some capital and you start. What really is motivating you to do that work, right? Again, it comes to the dream. So this is why I'm saying you need to have this very, very clear in your head that the dream is the fundamental thing. And it goes with the other one, which I call commitment. Now, the moment I say commitment, everyone goes, oh, Jagat, I don't want commitment. No commitment, especially college students, when I say no commitment at all. I want no commitment, right? But commitment is very, very critical to be able to achieve something. So there's another very important factor. If you're not committed, I think there is absolutely no chance of winning, right? So dream and commitment, I think, are the two biggest founder internals. You need to sort these in your head. I meet a lot of people saying that, hey, Jagat, I'm working on this startup, and then I'm doing this other thing, and then I'm doing this other thing, and then I'm doing, and I'm working in a job, and then I'm doing the startup also. I'm like, yeah, so why don't you just focus on the job? Right? Because there are people who work full-time, trying to, really beat you at what you're doing. And you think just half a day of work or something is enough. So that's not really commitment. And you cannot expect to be a unicorn with working weekends, right? So if you need to really achieve some good thing, you have to be willing to put in what it takes. So, and I don't want to get into what it takes, because then it gets into other HR issues, right? But it takes a lot of hard work, right? So these two things, I think, for students in the beginning, fix what you want to achieve in terms of a dream, and in terms of your own commitment, how much you want to spend your time and how much risk you want to take to do that. Now, the next one is the startup landscape, right? And this is all about how we're going to execute. So once you've got your dream and you've got the commitment, then you go through the process. Okay, now I'm actually going to start up. I'm actually going to build a company or build a business, build a product. So now we really need to get into a space that makes sense, right? So if, let's say I started a company that was making handsets today, phones, do you think I would be successful? High possibility, no, right? But then if you said that to Apple, maybe they disagree, right? So I think how to kind of get into the right space is very tough. So for me, I did social commerce in 2010. And that was only because we felt certain ways about what is social commerce. It is about moving of products through consumers, right? That's what we felt. And that's why we built it. There's no definition of social commerce, and till today, it's not done in a great way, right? So, and then a lot of other, sectors, try and pick a sector that, how do I put it? One is that, we have a formula for this actually in the sessions, but let me quickly break it down for you, right? So how to pick the right market. So there are like 5 P's you need to use. This is again, not by me. This is by one of my mentors. And there are 5 P's you need to have to pick a right business, right? So one, the most fundamental, I would say, is you need to have a passion to solve the problem, right? Because as I said, when things go down, it's only things that you're passionate about that you will actually do things when things are down. If there's something that if you're not passionate about, typically you won't do it if it doesn't pay you. So you need to have passion. The second is, it needs to solve a problem, right? If let's say I'm building, I'm just building another mineral water bottle company, right? Now, yeah, drinking water is a problem, but how is it happening differently with what you do? It's a price, or it's the quality, or what? So there's got to be something, a big problem that you're solving. Let's say bottles have, a lot of plastic stuff around them, and they're contributing to, again, it's a vicious cycle, right? They try and clean the water, and then they only dirty the water. So it's kind of weird. So then you say that, no, so we have a different mechanism where you get mineral water on the fly in taps through ATM kind of system. I don't know, right? Something different there, so it'll make sense. So then you're solving a real problem there. And that problem has to be solved for a person, right? A lot of people, especially in startups, we all tend to build products for everybody. Oh, who's it going to suit? X, Y, Z, A, B, C. No. That's all good for enterprises to do. You need to only focus on A. You need to focus on one particular person, not even, I wouldn't even say a TG or an ICP and all this stuff. It's one specific person or a person type that you actually are going after, right? And another critical thing is that you micro niche it. So I just can't say I go after entrepreneurs. I have to go after SaaS entrepreneurs or fintech entrepreneurs or health tech entrepreneurs. So you need to have a micro niche. And let me tell you why that's important. Do you think today MBBS general practitioner, again, with all due respect to general practitioners, do you think they make more money, or a specialized oncologist makes more money? Right? It's quite simple. The specialization makes more money. And that's because he's in a micro niche. He's not just a doctor. He's a doctor for cancer. He's a doctor for heart. So then you can start seeing things. So Most people say, okay, I'm an e-commerce for, I don't know, eco-friendly stuff, products. No, that's not good enough. There are too many people doing so-called circular economy, sustainable economy. No, it's I'm doing e-commerce products, blah blah, for women or for corporates or for post-pregnancy mothers. Now that makes a lot more sense. So for startups, you look at a micro niche that will define how you get, because most markets are taken today. All of humanity, we only need few things, right? Eat, sleep, procreate, stuff like this, entertain ourselves. So everyone's quest is the same all through time. So now we just do it differently. We used to pass our time walking around or just playing games outside. Today we spend it on our phones looking at WhatsApp and playing Candy Crush, right? So it's the same thing we're doing. What are we doing? We're passing our time. We're entertaining ourselves. We are eating food. So before we used to eat food at home, today you eat it from the home kitchen, in the cloud kitchen, whatever stuff. So humans, we do the same thing. We're after all humans. There's only so much we can do, right? So think about this very deeply. Most markets are already taken, and today you need to move to the next level of the niche itself. You move to micro niche and you'd find it's like the riches are in the niches, right? So it's as simple as that. Sorry? Yeah, the riches are in the niches. Yeah, and now the team. Again, so typically we have a lot of startup literature around single founder companies, 2 founder, 3 founder, 10 founder. Infosys is about 10 founder company, like something like this. Infosys started with 10 founders, I guess, or 8 of them. And it worked all right. So normally if you go to an investor today and say we're 8 founders, they'll be like, get out of here. Right? You have too many people in the startup team. No, but Infosys did. So anyway, so for team, I like to again come back to what we are building. We are not building a startup. We are building a company, right? And my father is a corporate consultant, one of the people who wrote Companies Act 2013. So kind of we grew up talking corporate governance and balance sheets and stuff like this. So I take the word company very seriously. The company literally is company. It is your people that you hang out with in the business. And that's how I like to look at a company, right? Would you like to have dinner with them? Would you like to play golf with them? Would you like to also, suppose you have no money in the company, would they still be with you? I think these are the very critical aspects to build a team. And over time, I mean, before obviously we all had these, we felt like Google was great or Facebook was great. But over time, I've begun to realize that think of your companies more as, metal bands like Metallica or a Pantera, right? Or you can think of it as Bob Dylan. Now, Bob Dylan after 50 years is still relevant today. And that's how you need to be thinking about the business, because I think most people are just building pop stuff. It's going to be there for 3 years and it's going to disappear. Now, don't look to do that. Build, and the essence is, again, what is the message? Who is the messenger? Right? There are only 2 things about what you do, the message and the messenger. So think of it this way, right? So a startup is not just something like an endpoint. Think of it as something that's going to last for a while and become a big company. Only then I really think you can build a unicorn, a sustainable unicorn, not a unicorn that is just, based on venture funding that you can claim that you're a unicorn. But to go by it the scientific way, you approach it with logic, then I think it's a lot easier. Teams, again, it's like marriage. At least your early team, right? Later on, there are HR processes and people know how to manage and lead bigger teams. But building small teams is as much an art as it is a science. In fact, it's very little a science and more of an art. And you need a lot of luck to have people. And the best way I like to think about building sustainable teams is always think about the other person. So if everybody is thinking about the other person in the team's going to be okay. What happens typically in teams is you always look at yourself. And that's the only problem. So the moment we have a team or the company, think about how you can help 5 guys. And automatically you have 5 guys in your company who are trying to help you as well, right? So that way you build your own kind of mastermind group. Yeah, so that's the startup landscape. And according to Andreessen and Mark Andreessen, market over team also. So this is a bit of debate. Some people may say team over market, market over team. But what I've seen in my life is that it's difficult to pick, right? You really can't say, because today video chat and communications is big and it is really nice. In 2016, when I started here in India, there was really nobody buying video conferencing or chat. And the same thing that we were selling, that everyone uses Meet and Teams, we were selling in 2017. Nobody ever bought it. It's the same product, same team, right? But today, of course, we sell Maserati effectively on on video chat. But I think what's important to understand is that it's really, I would say, a 50-50. And there's a bit of a founder trait also that matters, which will kind of make one more important. Okay. So typically these two are very critical, the market and team. Everything else follows that. So market into the customers and leads, prospects and everything. And then your team follows into, your leadership team, and then your people right until the fresher guys you hire. So now let's come to the startup skills. I think I'm almost running out of time, so I'll just take 5 minutes to wrap up. Now, this is a big thing. It's a lot of work, but I just break it up into two. One called networking, which I think is very special and is underrated, but it's very important for most founders. I typically see that founders do not go and talk to people. They expect that they build the product and the customers will come and the money will hit their bank account. No, life doesn't work that way. So you need to actually get out there and be a master at networking and knowing people. And this again starts by being a community person. You have to really work for others. If you work for yourself, people see that through, especially in this day and age. Try and help others, and eventually the universe will help you. Startup systems. So running a startup is about doing 8 things on a day-to-day basis. It's what I figured out. And these are in no real order of priority, but you need to cover, marketing and advertising, sales, support, product, operations, HR, admin, accounts, right? So these are like 8 things that, you can actually go back to your school and you remember your school timetables, right? We all had school timetables that we would stick into our diaries, right? And we'd see the day, the schedule. So you can, and that typically had 6, subjects with about 8 periods. We had 5 and then 3 or something like this. So think of your day, something like that. And you have about 5, not 5. You have about 8 things typically you need to handle. And at different times, different things will be important, right? So suppose you just raise some money, you may focus on HR more. Suppose you're just starting out, you may focus more on customer development and product. And later, suppose you become bigger, you focus more on the finance because you really want to handle bigger rounds. So as a founder, you have to keep, changing the degree you work on each, but everything's important, right? So these 8 things are critical. That's the domains or things you need to have some understanding about. I'm not a big believer in outsourcing too many things. You need to kind of at least know what we're doing. So that's very important. And in terms of startup systems, so each of these departments, the whole point of having a company and you're not a freelance CEO is that you have systems operating for you, right? That's the big difference between a freelancer and somebody who's an entrepreneur. Even if I am not well for a week, or I should be okay, but in case I do fall sick for a week also, still my Stripe and my Razorpay will tell me that, I've made enough money for the past week. And that's kind of an important thing to understand, right? Even, let's say if Mr. Mukesh Ambani suddenly didn't go to Reliance, he had to take a 1-month vacation, right? Would anybody ask him, hey, is that no pay? So that's kind of how it is. But the same thing, let's say you are working somewhere and you need a 1 month, then a lot of questions. So not that you won't get it these days. I think companies are today a lot better. But yeah, you have a lot of explaining to do. And many times you may not get paid for it. So the whole idea for between individuals or freelance kind of people versus CEOs and entrepreneurs is you build systems. Today, the government has done something great with Ministry of Corporate Affairs and all, where they have the OPC, the 1-person company, which I think increasingly is going to become a big thing. You're going to find, and we've been calling these things solopreneurs, digital nomads. We've been calling them all kinds of words. But I think the OPC that's defined is going to be very useful, because today I can run my entire business almost I wouldn't say single-handedly. I need my CTO. We can't work without each other. But I think with a tech person and a CEO, you can pretty much run every operation through software just by yourself. So I'm not a big believer in companies that hire and fire fast, because I tell them, you're not construction companies. Why exactly do you need to hire? I don't believe that 100 average developers are better than 3 good developers. Okay. Because you're building tech. So you need 3 good developers who are way better than 100 average developers. So this thinking, I think, helps in building sustainable stuff. So startup systems, I'm happy to share more notes on this, but I don't have much time, but we'll get to. So you need a content system, you need a funnel system, a lead system, a webinar system, a payment system, and you need like 8 or 9 systems. Okay. And that's all you need to run the business. This will handle your team, your customers, and everything. So I'd probably, there's some way I'll share some note or something and people can pass it on. Or of course you can, follow me on social networking and stuff like that. Some of my stuff is already there. So Now let's get to the last part, right? So the key, this is what we're trying to get to. This is like the promised land. When you do these things right, you want to get to 100 million. And believe it or not, you're at a 70 to 100% year-on-year growth rate. Now, look at any company in the valley that's grown like crazy, especially in the early stages, it's typically at 100% year-on-year. So Zoom today may do $1 billion. A year ago, they were doing less than 500 million, around 500 million. Before that, they were doing 300, they were doing 250. So you're typically growing 100% year-on-year. That's when you are a unicorn, because then that growth rate is going to come down significantly to about early double digit or a little more than that over your journey as a 20-year-old company, right? But when you're a unicorn, $1 billion market cap, not yet listed in the public markets, you need to be going at 100% year-on-year with a 100 million ARR. So this is, I think, how I've summed up this factors. I hope it's done some justice to your time. We can, I think on my last slide, I need to switch this. Yeah, so that's about it, right? So that's my thank you note. Live in the moment, live your purpose, make every day epic. Right? Happy to answer any Q&A, and thank you. Thanks to the audience as well. Any Q&A, I'm happy to take questions.
Thank you, Mr. Jagat, for explaining us about startups, unicorns, and most importantly, how to become a successful startup. The house is now open for question and answers, and anyone who have any questions, they can ask us. If you have a question, you can unmute yourself and ask the question to our panel of experts. We have received one question from registration number 467, and it was how to know what taxes should my business should pay. I request Shravan to take over that.
Okay, so under the Indian taxation structure, can you all see me? So the taxation structure in India has two branches. We call it as direct tax, where you have your income tax, wealth tax, etc. Wealth tax, of course, is not there anymore. And then under the indirect taxation structure, we have something called as GST, excise, etc. So depending upon the nature of the business that you have, say there are few products which have a specific excise duty that is charged. Otherwise, all products and services come under GST ambit. Depending upon the product that you have, there is a particular percentage that you're supposed to charge from your customer and add it on the sales invoice and collect it from the customer. That's how GST works, because that's indirect taxation. And direct taxation, that is income tax, is on the profits that you make, right? So at the end of the year, if you have made like 10 lakhs of profit, like in the example that I showed during my session, you see what is the accumulated carried forward losses that you have. You can set it off to the extent that are available. Only on the net positive number, the net profit that you make, there will be a percentage of taxation. Again, like the previous speaker mentioned, there are different kinds of structures that are available, right? He mentioned about OPC. There is a particular taxation structure for OPC. For a sole proprietor, there is a different tax structure. For a partnership firm, there is a different tax structure. So it depends upon the kind of organizational structure that you have your business set up in. So that's how the taxation works. I mean, if the student is still there, if I was able to address, or if there is something specific, please unmute yourself and ask. BP number 467. If there is something else, you can feel free to unmute, please.
Hello, am I audible?
Yes, you are, Bhuvan.
My question is like, what is the first thing you would expect from a pitcher who is coming to pitch at FKCCI Manthan?
Sorry, come again?
Like, what are the things you're expecting from a person who is pitching at FKCCI Manthan? His business plan.
So is your question in relation to the financial projections or overall business?
It is regarding the overall business plan.
overall business plan. Again, my other speakers, I don't know if others have joined, Usha and Chinmay, I don't know if they're online. You guys can pitch in, but from the financial projections, I will share my 2 cents. So what I expect these 212 participants who are there here today in terms of financial projections is at least a visibility of your incomes and expenses for the next 2 years, at least 2 to 3 years. So when I say a visibility, at least say, I took an example of a product, right? Let me take an example of a service industry. So service industry, if you are, say, a tech platform where you will have some subscribers on your platform for your business who will be paying some recurring income, there could be some kind of one-time incomes that you will be charging them, and then a recurring set of incomes, right? So you should at least be in a position to identify and put a price to the service that you will be offering on the basis of your market survey, on the basis of your competitor analysis, etc., and look into the foreseeable future, that is up to 2 years or 3 years, and put a number to it. This is what is the sales that I can achieve in the 12th month, in the 24th month, or anything in between. You can break it up month-wise and consolidate it only year-wise. The example that I showed you was year-wise, but effectively, how did I arrive at that? I looked at it in the drill down stage. On a monthly basis, I projected 2 sales in first month, 5 units sold in the second month, then increase it, because obviously you have put your efforts in terms of marketing, that is advertising, etc. You have started spending towards these. Your customer acquisition cost is definitely increasing. All those factors considered, that's how your sales are getting projected. So that is what is expected to be included in your financial projections as a part of your business plan that you will be submitting to FKCCI. So this is on the sales, this is on the expenses. Something on your cash flows also, to the extent that you can. I tried to simplify and explain your cash inflows and cash outflows. I'm sure that Excel sheet will be shared with all of you. You can play around with that Excel sheet from the point of view of your business and make necessary changes. So whatever numbers that you can put over there, money that I am raising from the investors, that I'm expecting to raise from the investors, I'm expecting to raise from, say, an angel, your friend or a family member is interested in investing certain money into your business. Capture that in your cash flow, capture that as a cash inflow in that particular statement. That statement, I'm sure, is self-explanatory. Anyways, the recorded sessions are available. You can again go back and look at it. So this is what is expected from you: sales, revenue, and a bit of information on cash inflows and cash outflows, so that we, as persons who are evaluating your business plans, evaluating your financial projections, can actually understand whether this is a commercially viable project, a commercially viable idea, a product, or a service. That's the bottom line. But when it comes to the other aspects in the business plan, other than financial projections, maybe the other speakers can add on in terms of expectations. Usha ma'am, would you like to add something?
Can you just, repeat the question for me, please, quickly?
So the student is asking, okay, the student is there. Bhuvan, go ahead.
Yeah, thank you, sir. Like, what are the things you would expect from a person who is pitching to FKCCI Manthan?
Well, really, what we are looking at in the business plan is what we discussed yesterday, 4 things. We need to, 1, look at the technical feasibility, whether your product is ready for the market ready, whether you've got the prototype or whether the product is complete. That's part of the technical feasibility, how far you have come in it, or how far you're likely to go a little further to complete the readiness of the product. Are you market ready, prototype ready, pilot ready, or launching ready? We would like to know what stage you are in your startup venture or your thinking venture. Is it still just at the ideation stage, or has it gone further to the design stage? That is part of the technical feasibility. The second thing we would look at is, if the product is, who is the market? Are there people ready to buy it? If so, how many people are ready to buy it? Who are your customers? Is it a local niche market? Is it an open market? Is it an export market? Are you going to use retailers? Is it a distribution process? What is the market? Is there a need? You have to justify it. Demand is different. Like yesterday we were discussing, demand is different from the need. So it's only when there is a need that a sale will happen. So within the market demand, you have to micro and get into who is the buyer going to be. Identify who are going to be your customers and what are the terms they are going to buy. So that is called the market feasibility. The third thing we look at is your infrastructure, what you need and how much it is going to cost you for setting up the infrastructure for your production plan. Yesterday we discussed, I was telling you about the sales plan, right? Once you get your sales in place, then based on the sales, you get your production plan organized. And for that production plan, you know how much labor you want, what is the infrastructure you want, how many people you want. And after you do it and you find that you are not, it's not working out, that the break even is going very, very high, or it's not breaking even within a reasonable period, then you know you need to increase your sales. The market doesn't allow you to increase the price, so you need to increase the number of pieces you're going to sell. And then if you have to do that, then you have to do the iteration, forward backward iteration that I was mentioning, which means you have to get back to the drawing board and decide what more can you produce. And if you can produce more, then how are you going to sell it? And that is the process that I was saying, that where you do the marketing strategy starts working, the marketing process starts working. So the market feasibility. So we talk about the technical feasibility, the production requirements and the feasibility, the market feasibility. And finally, we look at the financial feasibility. We put all this together, and what Shravan has spoken this morning and Shubha about the bottom line. Are you going to get a profit? And if so, when? We are aware, I think all of us are aware, that none of the businesses break even in the first. So you don't have to create figures to make people happy. I mean, let's be very clear. It's okay to show a loss in the first year if it is really going to make a loss. Don't need to manufacture figures to show a profit, or show that it's breaking even early to enhance the strength of your project. You don't need to do that. You can show realistically maybe second year marginal profit or marginal loss, and then third year is when you're going to make a profit. Or if it is a trading company, after 6 months you start making a profit. So whatever is realistic for your industry, for your service, or for your business, you show that. But you get that realistic, the more you plan, you get closer to reality. And the micro planning that you can do, it helps you minimize your risk. Yesterday we were talking of risk mitigation. You can't completely remove the risk. You're here for a higher risk and higher return. So you work to mitigate your risk on the areas that you can. You plug your weaknesses. So you get the financial feasibility. And finally, you put all these four together and you decide what is going to be your team. Who is going to be the team? Is there somebody who has strength in marketing, somebody who has strength in production, somebody who has strength in finance? Are they able to work together? That is important. The team cannot pull in 3 different directions. So what is your experience in working together? Can you pull together so that you can take your startup to greater heights? So basically, this is what we would be looking at, and what the jury also would be looking at for the evaluation. And the shorter that you can say it, the better it is. The less number of slides that you can have for your PowerPoint. Be very, very crisp on each topic, maybe just 2. So on technical 2, on marketing 2, on financial 2, and then on team 1, and then your own strengths and weaknesses, whatever it is. That's basically what we would require from a business plan. I hope that's clear for you, Bhuvan.
Yes, ma'am. Thank you, ma'am. And thank you, sir, for addressing my question. And I hope my pitch will entertain you and impress you on the pitching day. Thank you so much.
Welcome. All the best to you.
Yeah, thank you, ma'am. Thank you so much.
We have another question from registration number 320. Go ahead. Registration number 506. Please go ahead.
Yes, this is Shreyas. So we were developing one tech, so we want legality, sir. So Could we have some session
Shreyas, there's a lot of network issues. We are not able to hear you. Can you message it in the chat window? Text it. We are not able to hear you. There's a lot of disturbance and breakage.
Sir, can you hear me now? Just one more check.
You definitely have a nice voice, but it's breaking.
Okay. So, okay, sir, I will just text.
Yeah. So registration number 320. Sir, we should present same PPT which we sent to round one, or should we prepare another PPT? Who wants to take it? Usha ma'am, can you answer that? You are on mute. You're on mute.
Abhi, I'll take that.
Okay, Ankur, go ahead.
Yeah. So the knowledge session is being conducted so that you can fine tune your submission, whatever you have done so far. So if you feel that there are points that you can improve in your deck based on the inputs that you're receiving yesterday, today, and tomorrow, then please go ahead and submit a new one. Please remember that the format that has been given to you is something that will be helpful to be graded. So keep it in that format. And yes, please go ahead and update that if you feel that there are inputs that can improve your presentation.
Good afternoon. I had a couple of questions.
Please go ahead.
Yeah, so first thing is, since you have gone through our deck, do you have like a general feedback for all of us, apart from whatever that has been covered in the deep dive?
Ankur, do you want to take that? Usha ma'am, do you want to take that? You're on mute.
Kirti, could you please repeat that?
Since you all have gone through our deck, I just wanted to know if there's any general feedback that you think we could work on for the pitch.
Actually, what I'll suggest is, Abhishek, if that's okay, the marks that have been given to the team can be shared with them so that they understand where they are lacking. Without mentioning the jury names or whatever, so that they can get a feedback of what is lacking and what can be improved upon. So I think that will be helpful.
Yeah, that would really be helpful, because we got a lot of information from the deep dive, but if we could get like a personalized comment on where exactly we could improve upon, then our pitch can be crafted in the same way.
Sure, we can
if
get
I
that.
may add a little bit. In most cases, I think it was the marketing and the finance which was a little low key. And that's why we've spent time on the deep dive this time to give you more inputs on marketing and deep dive and finance. So those areas can be strengthened. Most people, the technical areas were reasonably covered because you've started from the product. But we are looking at it. If you're looking at it as a business, we like to look at it from the market point of view. What's what we were saying, your saleability, and what kind of turnover you're likely to make. So some little bit more idea on how much the whole thing is likely to cost you, and how much you're going to make at the end of it, and how you're going to market. These were, as a general area, we found that these were some of the weaker areas, but we had not covered it in the first level so much, which is why in the deep dive we have concentrated on these areas. So maybe these areas with a little bit more polishing up would round off your project well.
Sure, ma'am. Thank you so much.
Is this working? Yeah. Kirti, I went through about 20 of them, and first of all, remember this is a competition, right? So if the judges told you everything that was not good about your business plan, then everybody would have good business plans, which then makes the judge's job harder, right? There will be very little to pick and choose. But that being said, I think, of course, you can refine the business as you go on. I'm sure like there'll be people who can help you. But for the sake of the competition, I think all these ground rules and these sessions and we have a standard marking format, which I think everyone's aware of. So I think that's pretty much what you should know. And you see where you're not probably, aligned with something there, and I think you can fix that. But I think for the competition's sake, it would be tough if the judges gave everyone the feedback at this point, because then it wouldn't be a competition, right? Is that correct?
Yeah, that's fair. That's fair.
Yeah.
To answer to Ankur's point, I would rather not share the marks right now, or the thing, because it's a weighted average of 4-5 jury, and each jury have their perspective. So now maybe, like for example, a plan, jury one may give good marks on the marketing, but another jury may think otherwise. So it's all a perspective. So what we decided as internal committee is to give them the deep dive sessions based on the marks scored across the 400-500 plans that were received. So we have given more importance to the finance and the marketing side of things, which was weak in majority of the decks. So we would like the 212 teams to concentrate on the marketing as well as the financial aspect on their pitch decks, and kind of based on the learnings over the last 2 days, we're giving them an opportunity to make some modifications or changes and represent them one-on-one with the online presentation starting on the 1st of July.
I'm really sorry. I just have one last question to Usha. There are some businesses that purely depend on people's trust in your business, right? So in that case, how exactly do you want us to ballpark the numbers with respect to the market as well as finance? So if you could help me out with that, I think that would be great.
You're on mute. Usha ma'am, you're on mute. You're still on mute. Yeah, we can, no, you unmuted again. Yeah, we can hear you now.
Yeah, okay. Can I just repeat that question, Ma? I think I missed a little bit of it.
Ma'am, so a couple of businesses, not a couple, most of the businesses depend on the trust of people when you initially start off. So how exactly do you want us to ballpark the number for in case of market as well as finance?
Well, working on trust sometimes doesn't work. I always believe if the process is right, the result is going to be right. So whether you're doing marketing or whether you're doing anything else, you have a process for marketing. You have your delivery, you have your deliveries challan, you have your slips, you have an acknowledgement when the person receives it, and then you make a sale, and then you get the terms of the sale. So it becomes easy. But yes, then you're following the process. Even if you're trying to sell it to a relative or a friend or whatever, it becomes easy that you follow the process. So I always believe that make the process clear so that the end result becomes clear. And even then, if things go wrong, you know that you have the process to fall back on. And usually when the process is right, the result turns out right. In fact, yesterday I was wanting to mention to you, which I missed, one of the things that when you're entering marketing, when you're, one of the tricks that we had learned was that you try to market a product similar to what you're doing. Take up an agency, be a trader, buy from somebody and sell the product for even 6 months, 1 year. Then you know that, if you're selling, let's say, Bisleri water, go to the retailers, find out what is the customer complaint or acceptance level, what is the price, what are the terms, Then 6 months later, you start your own water production, Aquafina, whatever. You go back and tell the retailer that you would have built up a relationship. That trust doesn't come overnight. He trusts you now with a good product. Then when you go with your own product, he probably trusts you that you have a good product. And you can go and tell him, sir, now from Bisleri, I'm doing Aquafina. You don't even need to say that it's your own product, but you can if you want. And then you tell him, I'm now doing Aquafina, please buy. So it becomes much easier to break into the market. So get your experience in the line. If your production is the main thing in your industry, that get into an experience in a production line, work as an intern in a company like that. If marketing needs to be your forte, then get into marketing, market a product, 6 months, 1 year, 2 years, sell, take an agency and sell, so then it becomes easier for you. You gain the experience on the job while you're learning. Trust builds up over time. It doesn't happen overnight. So if you're there for a long time and you have worked yourself through difficulties, then you have the trust, you can rely on each other. But otherwise, always stick to the process.
Yes, ma'am. Thank you.
That answers your question.
Yes, ma'am.
If I can add to that, see, the way projections work are that, you must have learned about SAM, TAM, SOM in the knowledge workshops.
Yes.
Right. So just Google up on how to achieve those. And it has to be realistic. There are many sites that will give you statistics related to the industry. But one of the key mistakes that many students or the first timers do is that straight up they'll say that, say, for example, if I take the example of the water itself, right, that I'm selling Aquafina bottles and the total available market is 5 billion people, and out of that my SAM is probably 10%, and I'm saying that okay, maybe only 1% of that, so my total market is about 100,000 million or whatever. When the jury looks at that, they know that this is straight up cooked up numbers. Please make sure that it's realistic in terms of what you are targeting, and look for an exponential growth year on year. So usually when in real life we do projections, we do your worst case projections, your average projections, and then your best case projections. But here you're just doing your average projections. So just keep that in mind. I think that will help you derive. So one is the need for your product, and the second one is the market trends. So that is where your statistics come in, and then you do your SAM, TAM, SOM, and TAM, SAM, SOM, and then based on that, you can drill down and kind of refine that. I think for me particularly, that's an easier way to approach the numbers that we are targeting and what we are trying to see on year on the projections.
Yes, that makes a lot of sense. Thank you so much.
Good afternoon, Team Manthan.
Just 1 second. Who's that? Just give me 1 second. Yeah, I just want to chip in, right? So wonderfully said by Usha Madam and also Ankur. Hi, Ankur. Nice to see you there. Very well said. And I think your question revolves around trust. And, let me tell you that every business depends on trust, right? So why would you pay something? So what you're asking is typically your funnel, right? You're asking how many people of my leads are actually paying customers. That's all you're asking, because your paying customers trust you. And then you got to, your leads probably don't. And, or there is, they don't, you don't, basically you're not building something that they want right now, right? So if people want what you do and they are paying you money, it means they trust you, which means they are customers. It's as simple as that. So what you're asking about is to do with trust and want. So your leads basically are people who may not have the want, or they don't trust you, compared to the others. So the way you approach is just your conversion ratio, right? So that the more that are converting, that means more people trust you, right? People trust Apple because they have good conversion rates, right? So it's as simple as that. And in business, you're talking about a startup. You're not talking about a charity or political organization, right? Or nor are you talking about your family. What you're talking about is very specifically startup. And startup, if customers trust you, they will pay you, and that's all it is. There's nothing beyond that. And they continue to pay you, of course.
Thank you.
Registration 506. You can unmute.
Yes, sir. Now you can hear me, right?
Yes.
Yes. So my question was, I was building a fintech product. So I wanted to know about the legalities, sir. Like you had the session on financial projection and all. So now legalities, like how the product comes and like how we can like file the, like start building on it. Means how we should, like my product is about startup. Like I want to bring startup on board. So what legalities should I have and what government policies I should look upon? So those things, will we have any sessions that will be covering these things? So can I know that?
There is no industry specific legal input that is provided as part of the competition. I think the right answer for that would be for you to check up with a legal advisor that can advise you for your particular industry. For example, for the fintech, there are regulations from RBI that you need to follow. So those will not be covered in the sessions here. You'll have to reach out to somebody in the industry to get that input.
Okay, so can we reach Manthan, anyone in the Manthan to do that, if we can? No.
Sure. I think if you can reach
through email.
Sir,
You're
excuse me,
on
you're on mute.
Ankur, you're on mute.
Shubha ma'am, will you be able to guide him on that? Offline, in terms of where can he refer for the regulations, rules and regulations for fintechs?
He'll have to consult a lawyer. No, I'm a chartered accountant and it's little off my field. Maybe he can put an email to Manthan and we can try to see whether anybody can answer his question in a general way. For specific inputs, he needs to go to a specific lawyer who's an expert in that.
Sure.
Let him shoot us an email. Shreyas, please drop an email. We'll try to.
May I, Ankur, pick up this question, Dr. Manohar here?
Yes, Dr. Manohar.
Respond. Yes, when you talk about fintech is a too vast canvas, you have to be more specific. Are you talking about a gateway for payment? Are we talking about the process tool? Are you talking about, for instance, a blockchain, related fintech? Are you talking about, it all depends on what exactly is the product that within fintech you are talking about. We have some experience in this, having mentored a few entrepreneurs. So you could connect possibly through Manthan. You can connect. I think Ankur or the team can connect you. We'll be happy to.
Sure. Thank you, Dr. Manohar.
So Shreyas, if you could send us an email specifically detailing what part of the fintech your space you're looking for guidance, and if you have any specific questions, we'll try and figure out answers for it and try and connect you with the concerned resources as well.
Okay, sure. I will do that.
Thank you. We have a couple of questions from the chat window. How can we network with industry people that we are going to enter? What should we do if they discourage us for being a competitor? Wow. Anybody wants to take it?
For networking, the best thing is to go into events and event specific to your industry. That's the best way to network. Even FKCCI, for that matter, is a place where we all go to network with people. In terms of discouraging, if you want to be an entrepreneur, please be ready to be discouraged. Your family is going to discourage you. Your friends are going to discourage you. Your girlfriend, your boyfriend is going to discourage you. So competitors discouraging only is it's a motivation, because if they see you as a danger, that means you're doing something right. So learn to channel discouragement into encouragement.
Registration 467, is there any specific industry you're looking at to network with? If you could give us the details, we can definitely connect you with that specific industry. And as Ankur mentioned, entrepreneurship, nobody going to encourage you, nobody is going to support you. Everybody are only going to talk 10 things why it would fail. So you need to be confident, answer all of them positively, and ensure your success.
So that's a great question, right? So here's a tip, because all of you are students. I want to give you this tip very early. So the moment you meet, and typically everyone wants to get funded, right? Everyone wants to raise funding. So the moment you go to a networking event, and if you see an investor, do not pitch him. Okay. This is my number one tip to everyone. Do not pitch that investor. Just say hello. If you can get his contact, and then go through. Don't go and start delivering your elevator pitch or your metro rail pitch to him. Okay. Because that's not the way to network. The first thing I believe in networking is that try and think about the community, right? Everyone out there is there to actually do business. It's obvious, right? That's why you have events and networking events. So that's the whole purpose. But the whole point is that if everybody starts pitching each other, then everyone gets a sense of resistance, and it's not fun. So I would say, if you want to be a successful networker, think about what you can contribute. Like, don't think about what you can get from the event, but think what you can contribute to the event, right? And that'll actually go a long way in you being a good networker.
I hope we answered your question, registration 467. Pramod Kumar, hello sir, what are the major problems or risks that service rendering companies face at their first stage when they entered the market?
I think this is very generic. It's very specific to each service that you are trying to render. It could be a price point. It could be the acceptability of the solution if it's an early stage solution in terms of the technology. So I think this is very, very generic. For a proper answer, you'll probably need to be more specific.
Pramod Kumar, if you can make that question a little more specific with regard to what you're seeking, we'll be more than happy to kind of guide you with the answers. Anyone else in the house who has a question can unmute and speak or type it in the chat window.
One more thing I wanted to ask Jagat for. Can you hear us?
Yes, go ahead.
Yes.
Sure.
Please go ahead and ask the question.
Yeah, go ahead and ask the question. Is that Invest INN? Is he speaking? 506? Yeah, we can't hear you, Invest. Can you come with question?
Now you can hear us.
Yeah, all good, man. Go ahead.
Yeah, so you were telling that startups and enterprises are different, but in a recent podcast I heard from this Paytm founder, he told that like we are not enterprise, we are startup because we always tend to innovate, and startups are always focused on innovation, and enterprises fail to do that because they stick to one thing and they take a lot of time for innovation. So we are better to be called a startup than innovation. What's your take on this, sir? Just wanted to know your view.
That's a good question. The first thing in life I learned is don't listen to Charlog. Right? Apple used to claim that they're the world's largest startup. Forget about Paytm. I'm talking about a $2 trillion company that used to claim they're a startup. Now, what they're trying to say is the sense of a startup, is the culture of a startup. Is Paytm looking for its business model? Or do you think they know what they're doing? Of course, they have a lot of other projects, but typically you're doing the UPI payments and the payment bank, and they've kind of found their business model, right? Now they're in a stage where they're looking to differentiate from their competition and add new verticals and stuff like that. So when you have found that business model, that PMF, and then you're moving towards growth, typically you stop. And of course, once you list a company in the public markets, you're not really called a startup. It's as simple as that, right? You may claim to have the culture. It's like, an 80-year-old guy says, I'm 18. Right? It's in the mind. It's probably a state of mind and maybe sometimes delusion. So I hope that answers it. Well,
yes.
You may think like a startup, but yeah, most people would not agree with what Mr. Sharma is saying.
Yeah, the behavior is startup, but they're working as enterprises.
Exactly. Absolutely.
Yeah. Thank you, sir.
So there is one more question in which they mentioned that When would they get the PPT of all the speakers? I would like to tell everyone by the end of the day, you will get the PPT of all the speakers.
So all the presentations are with the FKCCI office, and you would get a mail collaborating all the PPTs, as well as a link to both yesterday's workshop as well as today's workshop. We have already streamed it live on YouTube. So as we speak, each of you can actually go to the FKCCI YouTube channel and listen to the entire deep dive workshops which were conducted yesterday and today. And to clarify, today's session will be the last session. We are ending the deep dive today. We won't be having any other sessions. And based on the learnings from yesterday and today, you will have about another week, 30th June, by when you would need to kind of make your modifications to your business plan and submit the same to Manthan at fkcci.in. So we'd request all the teams to make their business plans ready by the 30th of June and submit their modified presentations, which to Manthan's email ID, and only the submitted business plans could be presented one-on-one online, and the jury team will be evaluating the business pitch, the pitch that you're going to make online. There are a set of do's and don'ts that we have formulated. Those also will be sent via email, the Manthan email ID. So please look at your emails by end of day today, where we are requesting for a set of do's and don'ts during the pitch that you would be doing during the first 2 weeks of July. Where can we submit our deck? So you submit your deck to our official Manthan email ID, which is manthan at fkcci.in. So on the subject line, you could add your Manthan registration number and then submit your pitch deck. Attach your modified pitch deck to the email.
Sir, can I ask a last question if you are okay with that?
Please go ahead.
Shreyas, 506. Yes, sir. So last one question was, if we don't know any answer to the question, which will be asked in the pitch deck, how we should respond? We should respond like we are working upon it, or like we should fake it, or we should be honest, like we don't know about this. Like what kind of answer do you expect, sir?
I think an honest answer goes a long way. I mean, I don't know, Ankur.
While honest answer goes a long way, I definitely don't want to see on the pitch deck that I don't know about this. Do your research and find the answer, consult people. Also, one thing that we have said earlier as well is that the pitch deck template is not a one thing fit all. It's a template. So there will be things in that which might not apply to your business. For example, things for a product based or a service based, the business plan differs for them, and a business plan for a B2B or a B2C will differ as well. So there are certain things in there which might not apply to you, so it's okay to remove them, but make sure that the key components are in place. I think there was also a mail sent you, your congratulatory mail, which carried those 5 or 6 points that make sure that these points are focused upon. So all the key major parts of the business plan applies to every single business plan, but there are minor things in that which may not apply. So you can skip that. You need not have that. So I hope that answers it.
Just to add on to what Ankur said, Shreyas, the way the first series of knowledge workshop was designed and the way the deep dive workshops are designed now are in alignment with that of the expectations from the students and their business plan, right? So you would find a session, you would have definitely by tomorrow, you would be in a better position to kind of answer all the requirements on your business plan. That's it.
And why did Manthan keep this thing virtual? Can I know that? Because most of the pitch will be of physical. So can I know about that?
Yeah, so we are basically inviting business plans from across South India. It's not only Bangalore or not only Karnataka. We are having teams from Tamil Nadu, Kerala and Telangana and Andhra also participating. So it would not be fair for a few to be coming physically and presenting and a few to be presenting online. It gives them an undue advantage, people presenting physically. So for this specific round, we are having everybody pitch online, where the jury will huddle up together and they will be evaluating everybody online. That being said, the next round, so from 212 we go to the 75, the top 75. Those 75 students will be physically invited to Bangalore, and they would be presenting it physically, and we would be evaluating their physical pitch deck. So the first one was only their pitch decks based on what they submitted. The next one is we are doing an online pitch deck and you actually present yourself. And then the third one is where each of you would be physically invited here, and we would be evaluating on your presentation and all the body language and everything. So again, as we said, language is not a concern. You could be pitching in Tamil, Telugu, Kannada. It really doesn't matter. You don't need to be fluent in English. As long as the pitch deck is in English, you can present in any language.
I think we've saved lakhs in terms of. I think we have also saved lakhs in terms of transportation costs. You actually think about it; it could be a few lakh. You never know. At least few tens of thousands. So going green as well.
Just a request that if you're going to be presenting in any language other than English, just mention that in your mail that you send with the updated pitch deck, so that we can ensure that there's an interpreter in case the jury does not understand that language.
Should the modified pitch deck be like what we're going to present it during the 10 minutes? Should the structure be the same as before, or do you want us to modify based on what the recent mails is?
So we would leave that to you. We're giving you a 10-minute slot. And we had given you all the information that we needed to give you already. So again, understand that we are not spoon feeding you. We are only kind of guiding you, giving you a template. But now if you choose to stick to the template, so be it. Or if you want to give your 10 minutes based on what you feel is right for your pitch, we are more than happy to accommodate that as well. Yeah, but the initial template was to kind of help you with the pitch deck, and then these deep dives are kind of giving you an in-depth knowledge of what should be in the pitch deck. But it is now your call on what you would want. Just limit your pitch to 10 minutes. That's all we request. So ideally, it should be not more than 10-12 slides. And it should cover these 4-5 topics that Usha ma'am and Ankur and all of us have been saying.
Perfect. Thank you so much.
So just to add to what Abhishek said, that different people have different presentation styles. So the number of slides vary on that as well. For example, when I prefer to pitch, when I'm pitching, I prefer to keep my slides with as less text as possible. So sometimes my one slide is just one picture. So I generally tend to have more slides. But one key thing is that please make sure that your slides do not have too much text, and do not repeat the same thing which is written on the slide. So ideally, your slides should have pointers, and then you are talking and explaining. There's always more weightage when the entire team is presenting. So make sure that you prepare as a team instead of 4 people in a team, and then one person comes and says, "Hi, I'm so and so. Hi, I'm so and so. I am so and so," and the entire presentation is done by one person. So please make sure that you present as a team, and which parts you're going to handle in terms of Q&A. So be prepared for that, so you save time in that.
Yes, thank you.
Are there any more questions?
Hello. Go ahead. 187.
Tarkesh here. Tarkesh here, sir. So, sir, I think this question would be specific to my problem. The problem is that I have not mentioned my team members' names during registration. So I'm the only one with the registration number 187. So can I single-handedly present the presentation on the day of the show?
Yes, if you don't have any team members on your business plan, then I mean, you'll be the only person who will be presenting.
Okay, that will be fine, right? There's no protocol that is against that. All right, thank you.
Yeah, there are quite a few plans who have only one member team, and there are a few with 2, a few with 3, and few with 4. So wherever there is more than one, we request the entire team to be presenting.
Okay, but sir, the problem is that I have marked for 4 members in my team, but I have not specified their names. And that is the reason I'm the only one in the team that is being shown.
I didn't understand. So you are a team of 4?
Yeah, I am a team of 4, but I have not mentioned the names of my teammates during the registration process.
So you can, if your business plan has 4 team members, it's not too late. In your pitch deck that you're submitting, mention all the 4 team members, and together all 4 of you can present.
Great. Thank
See,
you.
one of the reasons for mentioning the team is the experience or the expertise that each team member brings, right? So if you have a team of 4 people and say one person specializes in finance, one person specializes in marketing, so that gives you an added weightage on why that team is over there. So if you have a team and they bring something to the table, mention them and let them handle those parts that they are responsible for.
Sure, sir. Get it.
Any other questions, or can we just felicitate the speakers before we take the next question?
So I request our chairman Abhishek to hand over the token of appreciation to our eminent speakers, to Mr. Jagat Iyer first. Ms. Shubha Ganesh. And Shravan Guttur. Okay, he's on the call. Okay, fine.
Would like to
I now request Kirtan to present the vote of thanks.
before Kirtan presents the vote of thanks, are there any other questions, team? Are there any other questions? Okay. So I would like to personally thank all the speakers, and officially Kirtan will be doing the vote of thanks.
Good afternoon, everyone. We have arrived at the final juncture of Manthan 2022 Deep Dive Knowledge Workshop. Very happy and honored to be presenting the vote of thanks of FKCCI, the 14th edition of Manthan Business Plan Competition, one of the largest business plan competition that is happening in South India today. With today's participants, about 220 teams are here from Karnataka, Kerala, Tamil Nadu, Andhra, and Telangana. So this wonderful event has been curated and directed and also very well nurtured by our visionary leader, Dr. C.A. I.S. Prasad, who's been constantly nurturing young minds in order to, he's been through this process of knowledge workshops and working with incubation centers. He's been constantly driving in order to manifesting unicorns for the country. I also thank Mr. B.A. Abhishek, Chairman of Manthan 2022, who's been constantly nurturing and also putting everyone together to drive this knowledge workshop. Thank you very much, Mr. Abhishek. And also thank today's speakers who's presented today's wonderful session by C.A. Shravan Guttur on financial projections. So he's a chartered accountant and also director of FKCCI. We thank Mr. Shravan Guttur. And also a session on financial planning for entrepreneurs by C.A. Shubha Ganesh, who who is a independent director at Elforge Limited. Thank you very much, Shubha Madam. And also thank a session on factors that make startup successful, Unicorn, by Mr. Jagat Iyer. I think his quote, riches are with the niches. So that's a wonderful line. And I thank you for being part of this event, and also good luck on your future endeavors, sir. Also thank the co-chair, Mr. Ankur Basin, for being part of the event. Also thank Usha Nagraj, Madam, as a mentor for this Manthan workshop. Also thank the jury committee, workshop committee, for curating this deep dive workshop. Would like to thank our sponsors. We have Department of Industries and Commerce, Government of Karnataka. We have Department of Electronics, ITBT, Science and Technology, Government of Karnataka. We have K-Tech, Startup Karnataka, Innovate Karnataka, Karnataka Digital Economy Mission, and we have Canara Bank, Axel Partners, SBI, Karnataka Bank, Amazon, and we have Indian Bank, and also as knowledge partners, we have the TIE Bangalore. And also would like to thank our technology partner, RB Group of Institutions, and Vishweshwaraya Technological University, Belgaum, and also Soundara Group of Institutions. Also, we have as partners, our sponsors, Don Bosco Institute of Technology, Children's Education Society, Bangalore, Shishadrapuram Educational Institutions, and we have Jane Launchpad. And also this event is being supported by CA K. Ullas Kamath. And also SSS Defense, Just Connect Bangalore, Spike Rent Power Bank, Ramaya Group of Institutions, Indigo Electric Private Limited, GSW Steel, Tally. And I would like to thank our Grand Jury Committee. We have our Chairman of Grand Jury Committee, Sri Prashant Prakash, Chairman of Vision Groups of Startups, Government of Karnataka. And also members of the committee are Sri B.V. Naidu, Chairman, Karnataka Digital Economy Mission, Dr. N.R. Banumurthy, Vice Chancellor of Dr. B.R. Ambedkar School of Economics, Dr. S. Rajendra Prasad, Vice Chancellor of University of Agriculture and Science, Bangalore, Sri Madan Padki, President, TIE Bengaluru, Dr. A.P. Achar, Chief Executive Officer at AIC Nitte Incubation Center. I would like to thank all the students who are part of this wonderful session, deep dive knowledge workshop of Manthan 2022, and also the mentors who are part of this event today. Thank you very much to all the institutions who are being part of this business plan competition. And also thank the subcommittee members. I think we have Ankur Basin, Pranam, Mr. Rahul B. Goel, who's anchored today, Mr. Shravan Gudatur, Mr. Suresh Kumar, Tejasri Narayanan, and all the members who was part of this event today. And also thank Mr. Karthik Kittu, who's also been a support for this event. Thank you very much, and thank you one and all, and thank you our tech support at FKCCI. Thank you very much.